Okay. So today we are going to start with the chapters of FRM, that is Foundations of Risk Management. Okay, there are 7 chapters in total in our agenda, and we'll cover them one by one. So first chapter that we're going to cover is the the building blocks of risk management, that is FRM 1. So without wasting any time, let's start. Okay. So in this chapter, we will see what are the building blocks, like what are the steps involved in risk management process, what are the different types of risk, the typology, basic typology. Okay. So major types of risk like market risk, credit risk, liquidity risk, operational risk. Okay. What are these things? In brief, we will see, and then we'll move towards the next chapter. Okay. So let's start. So if we talk about risk, so you see, usually what happens when we talk about risk, we confuse it with uncertainty. So, but there is a minor difference between risk and uncertainty. According to dictionary, if you'll see, risk is something when risk is a situation which involves that someone is exposed to danger. Okay. In finance, what is the danger? Exposure to danger is loss. Okay. So exposure to loss is considered risk. Now, risk actually involves uncertainty about the future events, like what will have future returns, like what will be the future returns. We are not sure about it. We are uncertain about it. Okay. And this uncertainty actually involves everything. Okay. If I talk about that, if I talk about the danger in future returns, then it is basically only on the loss side. Okay. This is a loss that can happen. But uncertainty means I'm uncertain what will happen. I don't know. Okay, it can go up also, it can go down also. So uncertainty is simply is simply the fact that we have no information about what will be the future returns. Okay, but risk is exposure to loss. Okay, however, opportunity comes with risk. Okay, so unless and until you are willing to take the risk, you may or may not have higher future returns, because as I said, there is uncertainty of future returns. Okay, so for example, if let's say um, there is some asset which is saying that, in which it is being said that, okay, the future returns are uncertain and the movements can be large. Okay, so if the movements can be large, it means that it can be on both sides. Okay, it can be on the lower side, it can be on the upper side. So if you are willing to take that risk, if you let's say decide that no, I'll go for this asset, so there comes the opportunity. There is a chance that you may lose money, there is no doubt about it. But if, let's say hypothetically, that the returns move on the higher end side, okay, let's say it increases, then there will be more benefit for you than what the risk you took, than for the risk that you are taking. Okay, so if we're talking about risk, then it should also include the upside prospects along with the downside dangers. Okay, so risk includes everything, upside prospects as well as the downside dangers. Okay, now risk cannot be always automatically linked to the size of possible cost or loss. Okay, it cannot be. And the actual risk is variability of losses or cost or returns. Okay, so sometimes what happens if we say that, okay, the risk is high. Okay, then one would say that, okay, you may lose more money. But there is another aspect to this definition also. Like, for example, in finance, when we are dealing with risk, it's not only about the losses. Sometimes you will be able to say that, okay, there can be a loss. Okay, like I'll have a downside movement, more of it. You know about it, but still you go for the asset. But the problem is, if you are certain about the loss, that means you're aware of what you are doing. Okay. However, if let's say there will be a loss and you're still not sure what the loss will be, that's what we call variability of the losses or the costs or return. And that is also something which comes under the purview of risk. If you know the loss, if you know the fact that there will be a loss, but you're not certain what the loss will be, that is also a risk. Okay, so if you are counting everything, if you have estimated everything to a greater extent, and you know what the loss will be. For example, expected loss, we know, like we calculate expected loss. This is something that we are already aware of, that this is something that can happen. Okay, however, what we are not aware of is the unexpected loss. That's the variability of loss we are talking here. Okay, and when it comes to risk capital allocations, it is not the expected loss that is only being covered. It's the unexpected loss also. We also prepare for unexpected losses. Okay, so what happens, we studied in the credit risk chapter, right? that expected loss is generally incorporated in the interest rate being charged with the borrower. Okay. However, we also had unexpected loss. That means the extreme loss value, okay, which can happen over the next period, okay, over a given period of time. So for that, we used to make an allocation, rough allocation. That is basically the difference between the expected loss and the unexpected loss. Okay, so that's why risk here is not only about the loss, it's about the variability of loss, like how variable the loss can be, so that accordingly we can prepare for it. Now let's talk about risk management versus risk taking. So what happens? Risk management is basically concerned with minimizing the chances of incurring expected losses. So when you do risk management, it reduces the chance that you will incur expected loss. When you do risk management, you calculate the expected loss, you charge it to the investor, you charge it to the borrower. So that actually is reducing the chance, is minimizing the losses that you are incurring. Okay, it's not completely eliminating the loss. There are still chances that abnormal defaults will be there and I'll still lose it. I'll still end up losing money. Okay, and for that we have the risk capital structure. Okay, now risk taking on the other hand means you are taking risk, okay, in order to achieve gains, because we know opportunity comes with risk. Okay, so risk taking is the fundamental aspect of any business. Unless and until you take risk, you cannot achieve gains. Okay, and risk taking can be perceived in an opportunistic way. That's why. So risk management and risk taking are the two sides of the same coin. Okay, so it does not mean that if you're managing risk, you're reducing the risk to zero. You can never reduce it to zero. For example, let's say you plan to use derivatives to reduce the risk. Okay, so you had exposure to commodity prices, so you used commodity futures contracts, for example, okay, to mitigate the risk. Now here, what happens? Let's say you initiated a perfect hedge for the time being. Let's say, assume that. However, they are rare, but let's say we are able to establish a perfect hedge. The problem we still have a problem in this case. Okay, and the problem says that, okay, even if it's a perfect hedge, so my market risk, that is the commodity price risk, has been reduced to zero. But now I'm exposed to new types of risk. Since I have taken position in a derivative contract, I'm exposed to counterparty risk. Okay, I'm exposed to liquidity risk, because we have seen liquidity crisis happening because of the abnormal fluctuations in the futures prices, and there can be margin call which a company or an entity may or may not be able to meet up when the time comes. Okay, and we have seen instances in the past. There have been disasters like Metal Gizzle Shaft was there. Okay, so they had a really good strategy on paper, but when it came to practice, Metal Gizzle Shaft was not able to ensure that they have sufficient funds when there was a margin call. Okay, so liquidity risk arises. So it does not mean that you will always eliminate the risk. One risk may be completely eliminated, giving rise, but it will at the same time give rise to other types of risk. Okay, so risk management and risk taking are two sides of the same coin. So if you are managing risk, you are taking risk also. Okay, so sometimes you'll be managing, sometimes you'll be taking it. Next, expected versus unexpected losses. So expected loss basically is the average loss in a position that might a position taker might expect to incur from a position or a portfolio. Okay, it's basically what is being expected, the average loss. Okay, that is being expected, and there are multiple ways to calculate expected losses. We know that. In case of credit risk, we have probability of default times exposure at default times the recovery rate. Oh, sorry, 1 minus the recovery rate or loss given default. Okay, that gives us the expected loss on a loan portfolio. Then we have unexpected losses. We have seen what unexpected losses are already in the credit risk chapters, where we saw that unexpected loss is basically the extreme loss, or you can say the extent to which the loss departs from its average value on most of the occasions. If I talk about 100% of the occasions, then it can depart to any value, practically, theoretically. Okay, but at a very high confidence level, let's say at 99.9% confidence level, what is the extreme loss that you can see? Okay, that loss level is considered the unexpected loss level. Next, the building blocks. So there are 10 building blocks of risk management. Okay, first is the risk management process. Then you have identifying risk, knowns and unknowns. What are known risk, what are unknown? Okay, Then you have expected loss, unexpected loss, and tail loss. Okay, so there are three things that needs to be considered when you are trying to do risk management. First is estimating the expected loss. Second, the unexpected loss. Third, the tail loss. Tail loss basically it in some ways refers to the expected shortfall kind of thing, where you are just focusing on the tail and you're seeing that, okay, if I'm in the tail region, if let's say extreme loss is breached, okay, unexpected loss is breached, then what possibly will be worst possible loss? Okay, the tail loss. Then risk factor breakdown, like what are the risk factors, how do they affect the asset or the business or the project under consideration. Then you have a structural change from tail risk to systemic crisis. Okay, like if sometimes what happens, if let's say there is a problem in a bank, and let's say losses are on a very extreme side, then how it can then transform into systemic risk. We can have a domino effect. We have seen a lot of examples in the past happening like that, okay, where a crisis of a single company transformed into a systemic crisis. Then you have human agency and conflict of interest that is also needs to be considered. Like you see, no business is run without humans. Okay, there is an human interference. So you need to understand what are the human agencies involved, and there can be a conflict of interest also. So risk management division might not agree with the senior management decisions. Okay, so there can be conflict of interest, internal also and external also. External in the sense, let's say shareholders and management may not agree on certain things. So there can be conflict of interest, which can lead to problems for the organization, giving to another types of risk. Okay, giving rise to that. Then typology of risk and risk interactions, like what are the broader types of risk and how different types of risk interact with one another. One example I've already given just now. So for example, when you were hedging commodity prices using commodity futures, so you actually were managing market risk, but at the same time it gave rise to counterparty risk and liquidity risk. Okay, so these things can happen. Okay, or in other words, let's say initially your exposure was credit risk, but later on it got transformed into liquidity risk and finally giving rise to market risk. So let's say you had a loan portfolio. So you had exposure to credit risk. Now a lot of people have started to default on loan portfolio. So let's say based on those loan portfolio, you had issued certain securities. So you will find it difficult to meet up the security obligations. Okay, then there will be after that it may give rise to market risk, because after some time your securities value will start to fall, your stock prices will start to fall. So just a single credit risk so risk do not occur in isolation. That's what is being said by risk. That's what it means by saying risk interaction. So they interact with one another. Okay, maybe a simple operational risk can give rise to market or credit risk or something like that. Things can happen in that way. Then you have risk aggregation. So once you have identified the risk, the types of risk, you need to aggregate it. Okay, so what happens, like you might a financial institution might have different divisions. Okay, now each division is working separately. They have their own estimation of different types of risk capital and all. So the problem in this here is that they don't know what other departments are doing. Now sometimes what happens when you take the aggregate picture, like on the enterprise level, what is happening. So you will find quite often that some of the risk exposure will cancel out one another. Maybe risk exposure in one department is just the opposite of risk exposure in other department for the same type of risk. So risk aggregation can actually help. And at the same time, it also gives the management, the top management, the board of directors, an idea about what is the amount of total risk that is being taken by the amount of total risk that is being taken by the company. Okay, so in that way they are able to look at the bigger picture, that okay, this risk is too much huge, we need to do something about it. This risk is something in which we can explore more. Okay, we have appetite for this kind of risk, so we can explore more opportunities in this side of business. Okay, so these are the things that we get to know after we do risk aggregation. Then balancing risk and reward, as I said, it's this next step that the decisions that the management was taking after risk aggregation, that okay, here I have too much of a risk. Okay, so I need to reduce it, and the reward is not too high. Okay, so I need to reduce the exposure here. But on the other side, in this side, I have a little lower risk and the reward can be increased. So balancing the risk and reward becomes the next step, unless after you do the risk aggregation. Okay, then you have the enterprise risk management, ERM. So once you have the risk aggregate risk of the company, once you are willing to balance the risk and reward, then the management of risk now becomes enterprise wide. Okay, it's not anymore silo based risk management, where so each departments are working in isolation. Okay, you are in everything is culminated together, is aggregated together, and then On the overall basis, things have to be managed properly. Okay, so how this enterprise risk management structure can be put in place so that this whole thing works really well. Okay, that comes under the purview of ERM. Now, typology of risk and risk interactions. So if we talk about typology, so major types of risk that we are going to cover. First is the market risk. Market risk is basically the change in market prices. Is basically the risk that the change in market prices will negatively affect the value of an investment. So let's say you're investing in a stock. So we are exposed to market risk because there's a change in stock price. The market price of the share can have an effect on the investment that you have made in that share, in that company. Okay. In the same way, anything like commodities or price of any financial asset, if you're buying or selling that price, even if it's a bond, okay, government bond, so their prices can fluctuate, giving rise to market risk. Okay, you are not worried about the credit worthiness. Let's say the bond issuer is highly credit worthy, but still its price can fluctuate. May not be to a by a very large value, but it can fluctuate. Okay, so let's see what comes under the purview of market risk. First, we have the equity price risk. That means the share price decreasing. Okay, you have general market risk and a specific risk. General market, like overall market is seeing a turmoil, then every equity will be falling. And then you have a specific risk where the specific investments, like specific equities in which you have invested, are performing poorly. Okay, so all these things come under the purview of equity price risk. Then you have commodity price risk, where the prices of commodities are fluctuating. Then you have foreign exchange risk, where the exchange rates are fluctuating, which can have an effect on the future transactions that you're about to have. And when it comes to financial institutions, they have a lot of future transactions, or foreign transactions. Okay, in the present also and in the future also. So they are exposed to foreign exchange risks. Then you have interest rate risk. So if there is a movement in interest rate, it can have an effect on your earnings, especially for the financial institutions. Okay, so that gives rise to market risk. Now, interest rate risk can come into two ways. The first one is trading risk, and second one is gap risk. Okay, so these are the basic subtypes, or you can say subcategories of market risk that you can keep in mind. Next, what we have is the credit risk. So credit risk basically is the risk of loss due to a counterparty's failure to fulfill contract obligations. So let's say you entered into a contract, futures contract. Okay. Now other party is under obligation to do, let's say, to fulfill the terms of the contract when the time comes. Okay. And let's say the time comes and the other party refuses. That's what we call credit risk. Okay. You had an exposure towards him, and you are not getting what you are expected to. Now there are multiple types of credit risk. First one is default, where you are worried that the other party will altogether default. Okay, they will not meet up the obligation. Second is bankruptcy. The other party goes bankrupt. Let's say the contract was open, but other party goes bankrupt. Okay, so bankruptcy is another. Then you have downgrade. Downgrade is not basically a default or bankruptcy, but sometimes what happens, maybe because of certain things. Let's say you had purchased a certain bond which had a certain credit quality, let's say AAA. Okay, now after some time, let's say the rating agencies uh, reduce their credit rating. Okay, and now they become let's say AA plus. So in this case, there is no default technically, if you'll see, but for the company who had invested in this bond, now it will lead to more cost. Why? Because since previously they had invested in a AAA rated bond. So for a AAA rated bond, the default probability, the default has not happened. The expected loss we are talking about, the expected loss for the AAA rated bond will be less than the expected loss for a AA rated bond. Okay. Now, since the credit rating has downgraded, they will have to increase the estimate of expected loss and at the same time unexpected loss, thereby increasing the capital charge, credit risk capital charge. They will have to make more allocations. Okay, in other words, they will now have to, they will be left with a little less money to do their day-to-day businesses. Okay, because more money is now captured by the credit risk capital. Then you have the settlement risk. Let's say the settlement has to be made. Okay, there is no default, there is no bankruptcy, but a settlement has to be made and it is not made on time. That is also called credit risk. Okay, so let's say there was a transaction happening and the settlement date was, let's say, today, but today the settlement does not happen. Okay, that is also a type of or let's say the counterparty did not make the settlement today itself. Okay, so that's again a type of credit risk. Okay, now what are the factors? that affect. So factors are borrower's quality, credit instrument structure, and exposure controls. Okay, so these are the factors that needs to be considered when you are estimating the credit risk. First is borrower's quality. It is always the first thing that should be assessed. Then credit instrument structure. What type of credit instrument you are entering into, you are going up for. Okay, that is also important to understand. And then finally exposure controls, that if something bad happens, how am I going to control the exposure? Okay. And for that, what happens usually, spread is charged. Okay, so you feel like, okay, there is a borrower which is a little bit more risky. Then what you will do, and let's say that's your business activity. Let's say giving out loans. It's your business activity. You will have to give out loans. If you don't give out loans, how will you survive in the market? So how you are going to cope up with this? So for this, what banks will do? They will charge an interest rate which is higher than average, and this excess interest rate charge actually compensates for the extra risk that is being taken by the financial institution in doing business with that borrower. Okay. Then you have the risk drivers. So there are three risk drivers which actually help us to estimate the credit risk. First is the probability of default. Then you have the exposure at default, and finally the recovery amount, the amount that you can recover if there is a default. Okay. Now, from here we get to understand two things, that there are two most important things that need to be addressed. First is default probability assessment. We need to assess what is the default probability, and it is done by analyzing key ratios like financial ratios or industry sectors, etc. If let's say we are talking about the borrowers who are like big corporations, companies, things like that, not people like us. Okay. So in that case, they need to assess the financial ratios, like their solvency ratios, their profitability ratios, their interest coverage ratios. There are different types of ratios that need to be assessed properly. Like if I give the loan, debt to equity ratio, if I give out the loan, first you will see that how much already loan it has taken. So for that, you will get an idea from debt to equity ratio. Then interest, then you will say you will look for quick ratio. Okay, where you want to assess if the status of liquidity for the company. Okay, it has to be liquid because it has to meet obligations. Will it be sufficient? Will the company be able to meet its obligation or not? Interest coverage ratio, will the company be able to pay out interest payments on time or not? Okay. Profitability ratio, everything will happen will hinge on only one thing, profits. Okay, there are multiple profitability ratios. So if they are not able to make profits, how are they going to make the payments? Okay, so all these things come under the purview of default probability assessment. Then finally, you have exposure amount volatility. You see, some transaction basically when they start with zero credit risk. For example, swap transactions. When they are initiated, they have zero risk involved. No party has any kind of risk. Okay. For the first transaction. But as the time passes, the interest rate can fluctuate, and this swap contract can have a positive value. Okay, for the bank. And when it happens, then the bank is exposed to the credit risk because the bank has now positive value. So bank is expecting to get something out of it. And if and naturally the opposite party who has entered into the swap contract has a negative value. So they are under obligation to fulfill that value. Okay, to provide that value that the swap has gained over time. So that's why it gives rise to credit risk. Now, if other party defaults, the bank actually loses on this value of the derivative contract. Okay. Next, credit risk at portfolio level. If we talk about portfolio level, there are portfolio level factors. Okay, like obligor concentration. So if you are looking at the portfolio, what are the factors? Concentration of the borrowers. So if let's say few loans are only given, but these loans are of huge amount and only to a specific borrowers from a specific sector, then you have a concentration towards that specific sector. If something bad happens in that sector, if let's say that sector starts to face some problems, then it will be a problem for you as well. Okay, just give me a minute. Yeah. So as I was saying, this can be a problem for you as well, because all the companies who have taken loan are now in turmoil. They will find it difficult to make the payment, and you will also see that, okay, you are finding it difficult to get the payment. That's the problem. That's a credit risk, right? And here, what needs to be considered, the most important thing needs to be considered is the correlation between risk factors like default probability, exposure amount, etc. Okay. So you need to understand, okay, uh, um, how the correlation between default probability is affecting your portfolio performance, loan portfolio performance, or how the exposure amount differs. Okay, is there any kind of correlation between exposure amount or let's say loss given default, etc. And there is actually when during the time of crisis, default probabilities actually are correlated in a way. So if one company defaults, there is a high chance that other companies will also default if they are in the same industry. So these are the things that need to be assessed properly. Okay. Now, second, riskier portfolios. So what are the riskier portfolios for a bank? So for example, portfolios with few large loans instead of many small ones. So few large loans, basically concentration risk. Okay. Instead of many small ones. Small ones, you are diversified. Okay, totally diversified. Then positive correlation between default probabilities. If let's say you have a portfolio in which default probabilities are positively correlated, which happens during the case of like lending in a specific sector. Okay, so if something bad happens in that sector, the default probabilities of all the companies in that sector will start to increase. Okay, so that's positive correlation. Then positive correlation between exposure amount, default probability, and the loss given default. Everything else. Okay, if there is a positive correlation, it's a riskier portfolio. Okay, and in order to diversify away this, they invest, they lend money to different people, um, um, different geographies, different regions, different sectors, if I say so. Okay, so all these things are done to reduce the riskiness of the portfolio overall. Okay, that's what we call diversification. So third natural thing that come to the picture is the diversification of strategies. First way to do is to avoid concentration on particular maturities. So let's say if you're issuing loans, let's say, then the objective should not be to issue most of your loans for a specific maturity. Okay. Like for 5-year, 10-year, or something like that. Okay, if let's say you have created a portfolio which consists, you are giving out loans only for a 10-year period, so you have a concentration in a specific maturity, and that can have problems. Okay, and you will see time and again. And so if let's say they have some maturities in certain specific year, if they have concentration at a certain specific maturity, then banks do take up certain steps in order to safeguard themselves for the asset liability management. Okay, so you might have seen the financial institutions, banks also, that I'll take a very basic example of fixed deposits. Okay, so you might have seen that certain banks offer a slightly higher rate for certain maturities compared to others. Okay, so one reason, I'm not saying that's the only reason, but one of the possible reasons for them to do so can be that they have more exposure for that year loans. Okay, so let's say that a bank is giving out loans. Let's say the bank has given out multiple loans for multiple maturities, and let's say bank has the highest concentration is in 5-year maturity. So most of the loans that the bank has given, or a lot of loans, are 5-year loans. Okay, now naturally they have to manage it. Okay, they have to fund it. They need to have sufficient capital, because deposits are short term. Okay, it can be withdrawn any point of time. They need a safeguard, proper safeguard. So for that, what they can do, they can go for fixed deposits and providing a little bit higher interest rate for the 5-year period, thereby giving an extra incentive for the people like us who invest in FDs. Okay, so that it becomes lucrative for us, that okay, why not invest for 5 years? I'll be earning, let's say, 0.5% more only, but it has an effect. Okay, compounding, we know everything. Okay, so that's something that needs to be done. Then diversify overexposures, geographies, industries, to mitigate concentration risk. We should not concentrate in one sector. It should be diversified. Okay. Exposure should be different. Not the exposures, all the exposures should be same. If I'm giving out loan, not all the loans should be of, let's say, 10 lakh rupees only. Okay, it should be variable. Some should be 5 lakh, some 1, some 10, some 15, some 30. Things like that should happen. Then it should be distributed across geographies, industries, etc. Then time diversification reduces liquidity risk. So if you diversify the time to maturity, like the different maturities loan, okay, it reduces the liquidity risk. So the thing is, it will be like, okay, you will so if I talk about loans, so loans are basically the income. If all the loans are for the same maturity, okay, for the same time period, then you will be receiving, and let's say if something bad happens, there will be a drastic decrease. Okay, now as if you have time diversification, although the loans will be expiring, of course, some will be expiring early, some will be expiring later, but At the same time, the risk exposure that you might have will be little lower. That means you'll be left with more liquidity at your disposal to do things. Okay, so that's the another benefit of time diversification. So time diversification, geographical diversification, industrial diversification, everything is exposure diversification, everything is important. Next important thing that we have is the liquidity risk. Liquidity risk is actually difficult to quantify, and it can be divided into two types. Okay, funding liquidity risk and market liquidity risk, which is also called trading. Funding means, let's say you want to give out a loan and you have to fund it. Okay. And the worst form of funding liquidity risk can be, we have seen it like, we have seen it during the 2007 and 9 crisis. Okay, a lot of loans that were given out, a lot of mortgage-backed securities that were created were backed by, were funded through short-term commercial papers. Okay, and we know the time came when the liquidity in short-term commercial paper, or you can say short-term commercial paper market, ABCP market, simply froze. No trade was happening. There was a point of time. Okay, so what happened? The banks were not able to fund their securities, and ultimately leading to the default of the banks, or of the whatever companies who were involved in it. Okay, so that's funding liquidity, where you need to ensure that you have sufficient funds to back up your securities. Okay, to back up your liabilities, assets. Next, you have market liquidity risk or trading liquidity risk, where you are exposed to liquidity problems because of the market fluctuations, like a futures price all of a sudden falling to a value where there will be a huge margin call. And let's say you don't have the money to meet up the margin call. That's the market liquidity risk. Okay, so liquidity is really important. And these things have happened. Okay, these things have happened. LTCM is a classic example of market liquidity risk. They were into some kind of trade where uh, they were looking for arbitrage opportunities, and the strategy was not bad on paper, but they were not able to foresee the liquidity requirements if there was an abrupt decline before the maturity of the contracts they were active into. Okay, or they had taken position into. So what happened? They failed to meet up the margin calls. Their positions were liquidated, sold off to other parties, and the other parties were actually able to make good gains on those positions. Okay, so liquidity is really important. Now, I have already explained what funding liquidity risk and what market liquidity risk is, so I'll not go into the details. Next, what we have is the operational risk. So operational risk is the risk incurred due to operational issues, like maybe your IT infrastructure went down, your server is not working properly, the controls are faulty in place, there is a fraud, maybe internal or external, some failure of the management in making some decisions, human errors can be there. Okay, natural man-made disasters, etc., everything. Okay, then you can have cyber threats that come that a company faces most of the time, especially financial institutions. Okay, so it can be defined as the risk of loss resulting from inadequate or failed internal process, people, and system, or from external events. It includes legal risk, the risk, some legal litigation. Let's say you step onto, it includes the legal risk, but excludes business, strategic, and reputational risk. Business risk means you are doing business, so the, of course, business risk. Strategic, that means you see, company makes strategic decisions. Okay, they take decision that, okay, we have to go for this, we have to do that. Okay, we'll be investing in this company, we'll go for a merger, acquisition, we'll invest in certain project. So all these are strategic decisions. If these decisions go wrong, then it gives rise to the chances that the strategic decisions can go wrong gives rise to strategic risk. Then you have reputational risk. Reputational risk is actually debatable. Some people say it should come under the purview of operational risk, but Basel has decided to keep it separate, reputational risk, and it arises because of the harm in the reputation of a company. Okay, it can be because of anything. Let's say the classic example is Nestle, Maggie in India. Okay, some there was some few years back, there was an issue of high amounts of lead was found in the Maggies. Okay, in a certain batch. So it led to a huge reputation risk, because Maggie is a household name. If you ask a kid like what they want to have, if they want to say it's a noodle, they don't say noodles, they say Maggie. Okay, so that's the kind of reputation they had built. And when it happened, like the lead issue, the excessive lead issue in their product, in the Maggie, so it led to a huge reputational damage. Okay, so that's the reputation risk, and it can easily transform into other risk types. Okay, It could have immediately led to liquidity issues for the company. It could have immediately led to other problems. Okay. Then you have business and a strategic risk. Business risk are basically traditional risk of running business. If you are doing business, you are like looking for the profits. You will take upon certain risks to pursue those profits. And risk taken because of the main business activities, you can say, are called the business risk because they will affect your income statement directly. Okay. Strategic risk involves making large long-term decisions, as I said, about the firm's direction, often accompanied by major investments of capital, human resources, and management reputation. You take certain decisions that, okay, we are going to do this over the next 5 years, over the next 10 years. So these are strategic decisions. And the problem with these decisions is that if it goes wrong, then what? Because if you are proposing something, you will be investing. If not capital, then at least human resource or management reputation will be at stake. That, okay, you guys said we will do this, but you are not able to do it. So that's a strategic risk. Then what are the example? First, political. Then you have talent management risk. Okay, if let's say you are not able to manage talent properly, then let's say you said that you will be hiring 15,000 data analysts over the next 3 years, but let's say you were not able to hire properly, and ultimately you had to lay off your existing employees also. So it's a strategic disaster. Okay. Then a strategy forecast risk. You are forecasting a strategy that, okay, uh, these are plans like the thing that I said right now. Okay, strategic forecast risk. So you had a strategy of doing something, but it did not played out. Okay, the forecasts were not accurate. So that's the risk. Talent management, you have the employees at your disposal. So you would want that the best of the talents remain intact within the organization. That because that is necessary for the growth of the company. Okay. And I should not say it, but I would say talent management is one of the reasons that when these people who are like in the top tier, who are in the top positions of the organizations, they usually face any charges, any legal litigations. They normally do not face any legal litigations when it comes to any kind of fraud or something like that. Take the global financial crisis. Almost the complete US financial banking system collapsed. Okay, but how many of the uh, top brass of all, including all the banks, how many of them were convicted at the end of the day? Taxpayers' money was used. There was bailout and everything was done. Okay, but how many of these top players? Because if it was happening, like if bad loans were given out, if incentive structure was bad, if let's say securities were not proper, okay, the model, the valuation models for those securities were faulty, everything was there. Okay, everything is now in plain sight. So it was at that point of time also, it's a kind of issue like elephant in the room problem. Okay, where there is an elephant in the room, but you just don't want to see it. Okay, you just don't want to see it. So why do they don't do it? Why these top management officials uh, were not convicted of anything? There was just one conviction, I think, in the 2007 and 9 crisis. It's because of the talent. Okay, all they did bad things. They did not do good things for the US economy. But at the end of the day, these are the top minds of the financial industry. If they are behind the bars, who is going to run these financial institutions? It's not possible. So I'm just giving you my intake. It's my personal perception. I'm not saying that it's good or bad. It's just my perception, just to explain talent management. Okay, so sometimes talent is really important and you need to manage it. Then you have innovation risk. So let's say you are into something now and a new innovation comes in. So that poses a threat, okay, or something, a problem for your company. Then that needs to be addressed properly. So for example, for theaters, a new innovation, OTT platforms had created a lot of problems. Okay, previously the the way theaters were looked upon for is not the way now. Okay, so it's nowadays, if you'll talk to people, they say that, okay, it should be worthy of watching at theater. Okay, we cannot watch all the movies in the theater, we wait for it to come on the OTT platforms. So OTT platforms are the innovation. So when there is an innovation, there is a risk involved that certain business activity or certain aspect of business might be affected drastically because of that. So that needs to be considered. Then competitive risk. There is a competition, of course. It is again related to business competition. There is there. So merger and acquisition risk. Again, it comes into business and a strategic risk where merger and acquisition can have problems. So the classic example in India was the merger of Vodafone and Idea. How well it had worked out, still it is unclear. Okay, but yeah, they can have risk. Okay, let's say a merger goes wrong. Okay, things does not turn out to be good. let's say there is an acquisition, okay, then that acquisition turns out to be bad. So these things can happen. Like in India also, I can give an example of acquisition which went bad. For example, Byju's acquiring uh, White Hat Junior. Okay, so it was not a good acquisition at that point of time. And even if it was, and let's say even if the plan was to acquire that entity, then it should have been done at a little lower price. Okay. Now, reputation risk. Reputation is in danger. You will suffer certain fall in market standing because and your economic there will be economic consequences. Okay, you will lose customers, you will lose counterparties, people will lose trust in you. That's the reputation risk. Okay, it can be divided into two classes: believe that entity is capable and willing to meet obligations. Okay, and believe that entity is fair and ethical. So reputation is of two types. First, reputation: entity is capable of meeting the obligations and will meet the obligations. So if this is the reputation at stake, then counterparties are at risk. Okay, so let's say the counterparties will start the counterparty. Let's say there is a shareholder. Okay, so shareholders have faith in the organization that okay, nothing bad will happen to my money. Okay, so that's the reputation that you have towards shareholder. Then another type of belief is that the company is fair and ethical. Everything is being done in an ethical way. It's fair company. Okay, so that also builds your reputation. So these are the two broad things that should be considered when building a reputation. Now, the risk management process. The risk management process basically involves 4 steps, and at each step you will have to evaluate all the time. Okay, first step is to identify, then you analyze, then you assess its impact, and then finally you manage. Okay, so identify means you will first identify, okay, where is the risk, if there is any risk event or not. Then if there is any risk event, once the risk event has been identified, you will analyze it, that how can I assess it, what are the ways, what are the factors that affect it. Okay, these are the things that you do. Then you assess the impact of that risk event. So if it happens, let's say in the future, what impact will it have on the organization's profitability or on the organization overall. Okay, on the different aspects of the organization. Once you assess it, then you finally decide to manage it. In manage, you have 4 ways to manage it. Okay, you retain it in its entirety, you avoid, you mitigate, you transfer. Okay, there are 4 ways to manage the risk. Okay, now what are the problems and challenges? First, corporate governance failures lead to market disruptions and financial accounting frauds. Then you have models and their role have led to a large number of questions with no easy answers. Okay, like models are there that have been used in the past, valuation models, but they have not been able to but during the crisis, we saw that valuation models being used for different kind of securities were a little bit faulty. Okay, and there is no definitive answer that how to improve those models. Okay, at the end of the day, when you're building model, you'll have to make certain assumptions, and these assumptions can go wrong, have with severe consequences. Like Niederhofer case was there, where the Niederhofer actually used to sell deep out of the money put options and was able to, or was deep out of the money options and was able to raise some extra income for their investors. Okay, but the problem was the assumption was that okay, the returns are normally distributed, and let's say a movement of 3 or more standard deviations was highly unlikely. Okay, but in reality, we know that the returns are not normally distributed. We have more frequent negative returns. Okay, extreme returns compared to the normal, what is being predicted by the normal distribution. So what happened there is that once there were occasions when extreme events happened, returns were more than 3 standard deviations away, and Niederhofer was like his plan failed miserably. Okay, because there was a modeling error. Okay, he assumed that the returns will be normally distributed, but in reality, it's not. So there are no definitive answers. Then risk management has to be aligned with the overall business strategy. So you need to understand what your business strategy is and then do risk management accordingly. So if let's say your business strategy is to take in deposits and give out loans. So you are taking in deposits, you're giving out loans, you're exposed to credit risk, you're exposed to interest rate risk, you're exposed to all these kind of risks. Okay. So what you will do? Will you will you mitigate this risk altogether? No, you will not. You will have to assume these risks. Okay, because that is your main business activity. You cannot stop that. You cannot stop giving out loans. Okay, how will you pay on the deposits then? Okay, so you will have to take upon credit risk. And the thing is, risk management in that case will mean that, okay, you will have to understand it, how much risk you are taking. Then you will have to charge the expected risk, expected loss in the interest rate. Again, one side of the risk management, and you prepare a risk capital for the unexpected losses. Okay, that will come under the purview of risk management. For a different activity, let's say all of a sudden the bank enters into, let's say, dealing. Okay. Dealer activities, and there they had to maintain an inventory and all, and they feel like, okay, we are exposed to unnecessary market risk. So they may plan that, okay, no, dealing was not at all our plus our business strategy. It's just something that we did for a while, so no, let's just stop it. Okay, it's not something that we can handle properly, so let's stop this business altogether. Again, it's a part of risk management. So risk management does not mean that you are always trying to reduce the risk. Okay, you're planning for the risk properly. There will be risks which you cannot avoid, which you will have to take in order to make profits. So for that, you will plan out that, okay, if there will be a loss, how will I cover up the losses? Line of credits, capital, um, excess spread, or the interest rate increase, that what we call. Okay, all these things are ways to plan out for the risk. You're willing to take the risk, and then you're planning it out. But in other circumstances, you are like, no, we won't do it at all. Okay, just close that. So their risk management means avoiding the risk in its entirety. Okay, so these are the things, and it has to be aligned with your overall business strategy. So here, in this case, you will not close out your loan business. That's the main business activity. Okay. Then use of complex financial instruments again can have problems, and trading strategies overstate financial position and understate risk. Okay, if you are using complex financial instrument, and these are the problems that happened in the past, that have happened. It's not something that is being said on the basis of some assumption or something like that. Okay, so something has happened in the past, and now there a lot of complex financial instruments were being used, and now we know that, okay, yeah, it actually understated the risk. When the problem came, everything fell apart actually. Okay, then availability, consistency, and organization of data management is a major concern. Data management is really important. If you're not able to manage the data properly, how will you get the insights out of it? Okay, and insights are really, really important. Next, what we have, risk management has to ensure implementation of regulatory demands. Regulatory demands has to be met at all times. Then aggregation of different risk types is also really important. Risk should be distributed among participants who have the willingness and ability to take risk. If it is possible, risk can be distributed. OTD model, originate to distribute model, was actually brought in as a way to distribute risk among wider range of investors. Okay, but things did not went well, and even in the securities market, they end up concentrating a lot. Okay, so that was the problem. Now, quantitative risk metrics. So risk metrics is not only qualitative, it's quantitative also. You can have definitive numbers. So for example, value at risk, it tells us how much you can lose in a given period of time. Then economic capital is the amount of risk capital which is needed to secure vital in the worst case scenario. We have seen economic calculated capital calculation, risk capital calculations, we call it. Okay. Then expected loss, basically exposure at default is expected loss is something that is covered. Okay. Now, scenario analysis is another quantitative measure that is put in place, and in fact, its importance has increased since the 2007 and 9 crisis, where we talk about what ifs. Okay, so what if this happens? What if that happens? Asking these tough questions is really important. Asking these worst questions, that okay, um, what if we fail? So what are the reasons that can lead to fail? That is which we call reverse stress testing, and all these things have come under the purview. Okay. Now, stress testing, another thing, is basically a form of a scenario analysis only, and it basically determines the ability to deal with economic crisis. Okay, like you will stress the economic factors like unemployment rate, GDP, all these things are stressed. Okay, uh, and then you have to test yourself that, okay, how will I deal with this scenario? I have to raise capital. I need more liquidity. How will I ensure that? All these things come under the purview of a stress test. Then finally, the balancing risk and reward. So usually what happens, if we are balancing risk and reward, then always the reward should be adjusted for risk. That is what we call risk adjusted return on capital, RAROC. Okay, which is basically the reward divided by the risk that is being taken. There is another formula to calculate RAROC, which is after tax net risk adjusted expected return divided by the economic capital. Okay, this gives us the RAROC, risk adjusted return on capital. You will study about RAROC in detail in part 2. Okay, here RAROC is just being introduced so that you know what RAROC is. It's basically the return you are adjusting for the risk being taken. If you are taking more risk, so you will adjust the return accordingly in order to compare it with other asset classes, that okay, comparatively how it has performed, whether I was able to get more return at a lower risk or not. Okay, so RAROC is something that needs to be calculated properly. So that's the end of the lecture. Just give me a few minutes. I'll start with the next. So now we're going to start with how do firms manage financial risk. Okay, so there are multiple things, and the most important thing that comes to our mind when it comes to managing risk is hedging. Okay, so we'll see what is hedging, what are the advantages of hedging, the disadvantages of hedging, corporate hedging, and then in order to manage risk, they do one more thing. Okay, two more things basically. They map the risk, that is what we call risk mapping, and they prepare a risk appetite. Okay, like what is the risk appetite, where they define the risk that they are willing to do, the amount of risk that they are willing to take, then their risk capacity, the maximum risk that they can absorb. Okay, now risk capacity is something that they would want that is never reached, because that is something that can be done on special occasions only because of their main business activities. So all these things we are going to cover in this chapter. So let's start. First, risk from using risk management instruments. So you see, in the last chapter also, when I said that, okay, if you are using risk management instruments like forward contract, futures, swaps, everything, whatever. Okay, so it helps you to mitigate one type of risk, but at the same time, it gives rise to another type of risk. That means if you use risk management instruments, you get exposed to yet another type of risks. Okay, so there can be exposures because of hedging as well. Okay, and this can quickly change the entire risk profile that you have within days, within hours. Okay, it can either reduce risk, or it can lead up to a buildup of a speculative position also. Okay, so that's why and biggest problem with these things are that they are not immediately apparent. So for example, let's say you take a position in futures contract or futures position to hedge a type of risk, and let's say you did not plan for liquidity or anything. Now all of a sudden, during this when the time the futures contract is active, there is a crisis, very short-term crisis, and all of a sudden there is a sharp decline in the underlying prices or increase in the underlying prices, whatever is bad for you. Let's say that happens. Okay, now what will happen? Naturally, the position is not closed out. Okay, there will be a margin call. Margin call means you need to deposit more cash. You are aware that, okay, after some time things will recover and you will be you will at the end of the day benefit from the position. But for that short period of time, there has to be a margin call made. Okay, there has to be a margin call that has to be there is a margin call that has to be fulfilled. Let's say you don't have liquidity. Okay, now what happens? You are exposed to liquidity risk. It was not immediately apparent when you took the position. It was not visible that, okay, there will be any kind of liquidity risk. You felt like, okay, the hedge is perfect. I'll at the end of the hedge, I'll end up getting this price, okay, for the underlying asset or whatever. But there is a sharp decline and in the market environment, and there is a sharp change in the market environment, and which has led to a scenario where you have to fulfill a margin call, and let's say you don't have liquidity. So what will happen? The central counterparties, the exchange, let's say, or whatever, they will immediately start the closure procedure. Okay, even before the hedge has reached its maturity, your position will be closed out by the central counterparties, and due to this, what happens? You are left in a worse position. So that's the problem. So it may not be immediately apparent. So you'll have to plan for it accordingly. Before taking a risk management hedging decision, you have to plan for it properly. You have to look at each and every aspect. Then here the same thing has been given. Let's say there is a firm which has a variable interest rate exposure. So uses a complicated instrument that dampens this exposure, provided that interest rates stay within certain bounds. And it has happened in the past. There was a case, I think, of Orange County or something like that. PNG was there involved also. They entered into some complex financial instruments where some movements in interest rate was beneficial for them. But if something extreme happens, it would have led to huge margin calls. And it was the problem that happened. It was then it created a lot of problem for the companies. Okay, so things like that can happen. So you need to understand properly that, okay, what you are doing, and if something you are doing is a risk management or is it a bet. Okay, you need to bifurcate that. There is a very fine line between speculation and risk management. So you need to be very, very sure that what you are doing is a risk management. Okay, now modern corporations, if we talk about, can have risk profiles traditionally associated with investment banks. Okay, all that is needed is a computer, the right passwords, and the permission of the board. So and one fat finger. Okay, the rogue trader risk that we have there. Okay, so these are the things that need to be taken care of all the time. Now, if you're hedging exposures, what are the disadvantages? First, it's that just because there is a risk, it does not mean it should be hedged. Okay, hedging is a tool like any other tool, and it has its own limitation. Okay, so if there is a risk, it does not mean that you should straight away go for hedging. You need to assess it. It is possible that you might want to keep it in its entirety because the upsides are way too much lucrative. So you would say that, okay, no, let's assume that risk in its entirety, or let's say it's related to your business activity. So in that case also, you would not plan to do a risk management or a hedging. You would not want to plan a hedging strategy altogether. Okay. Now, M&M analysis showed that value of a firm cannot be enhanced only by the means of financial transactions under the assumption of perfect capital markets. Okay, if you just do financial transactions, it does not mean that it will always enhance your financial position. Sometimes it can lead to worsen your financial positions. Let's say you put in place a risk management strategy to stabilize the prices. Okay, so it's not like it will be beneficial for you. Let's say if you stabilize the prices, it will stabilize your profit. That means you will see lesser growth in the profits. If you had taken risks, there might have been a chance of higher profit also. Okay, let's say the risk was not in place and things went favorable. You would be able to acquire raw materials at a lower price, thereby increasing the profits. Okay, but due to hedging, it could not have been. It will not be possible. You fix the price. No matter what happens, you will be procuring the assets at a fixed price and thereby restricting the profits that you can make. Now, CAPM also establishes that under perfect capital markets, firms should not be concerned with idiosyncratic or unsystematic risk and should make investment decisions only based on the common risks. Okay, so again, that another problem, that idiosyncratic risk or unsystematic, that means firm specific risk should not be considered. Investment should be made based on the broader picture, on the macroeconomic factors, on the unsystematic risk that on the systematic risk that cannot be diversified, because we know that the moment we start adding more assets in the portfolio, the systematic risk actually gets diversified away, or you can say in a way that it gets reduced. And always remember, hedging is a zero-sum game, okay, which has no long-term benefits on the firm earning or cash flows. Okay, it's a zero-sum game. If you are losing, somebody else is gaining. If you are gaining, somebody else is losing. So today you are gaining, tomorrow you will lose. So these are the things that happen in the case of hedging. Okay, so it's a zero-sum game, and in long term it has no clear benefits. So in the short term, maybe just to avoid some fluctuations, you can go for hedging, but all the time doing the hedge is not the right decision to make. Okay. Another, active hedging may distract the management from its core business. Let's say you are into active hedging. Okay, so all the time, a lot of your resource time will go towards managing the hedge positions and all, and thereby getting distracted from the core business activities, like managing the price of the raw materials all the time, and thereby not able to ensure the other aspects of the supply chain are working properly or not. Okay, then management might lack specialized skills required for hedging. Let's say the management do not have that skill that is needed to initiate a well-informed and good hedging strategy. Okay. Unsound hedging technique can result in losses. Hedging, if it is unsound, let's say they didn't have this specialized skill. They prepared a hedging strategy and they went for it. Okay. So it's an unsound hedging technique and it will result to losses one day or another. Okay. And every hedging strategy has a cost. Okay. So you need to be very, very sure that what are the costs that I'll have to incur if I am trying to reduce the risk. So you can reduce the risk, but there will be costs also. So cost benefit analysis is something that needs to be considered. And sometimes costs are opaque. Sometimes they are transparent, like the option premium that you pay. It is pretty transparent. You know what the cost of hedging will be, but sometimes they are opaque. Okay. maybe a rogue trading has been done, or let's say some tactical error happens, and due to that there will be some costs, some losses that will be considered as costs. Okay, hedging cost. Now, hedging via derivative can reveal protected confidential information. So if you are using derivatives to hedge certain kind of risk, so let's say you are hedging for something which is not known to the in the public domain. Okay, so the moment you start to use derivatives, people will start speculating, investors, that either you are taking a speculative position which makes no sense, or else you have existing exposure towards these kind of assets. Okay, so confidential information can be revealed quite easily. Then hedging can increase volatility due to gap between accounting earnings and economic cash flows. So accounting earnings like at the year end, and economic cash flows like when they actually happens. So there can be a gap between these two, which can lead to problems at the time of accounting, and that can be problematic actually. Okay. Then equity investors will not want managers to hedge the risk if the investor hold investment as a part of diversified portfolio. So if let's say you are a big shareholder and you have a diversified portfolio, you have invested money. So why would you want that company to hedge the risk for itself? Okay, because you know the risk, you have taken the decision according to that, and you have a diversified portfolio. So you know that, okay, if this company is not doing properly, then other companies will uh, compensate for it, because since I have a diversified portfolio, I'm not exposed to firm specific risks. Okay, so equity investors are not willing that, okay, they should do it. However, it's not a completely true statement. We have read it in FMP chapters, hedging, using futures for hedging, that why this may not be a good argument, because not all the investors are sophisticated enough, not all the investors have large enough positions to manage the risk themselves. Okay, so that's why the company has to step in. However, there are certain advantages also. Hedging can lower the cost of capital for a firm, first and foremost example. Then reduced volatility indicates good management. If you are able to reduce the volatility in the prices and the profits and all, then it means that you are managing things properly. Okay. Hedging can bring about operational improvements. Hedging via derivatives can be cheaper than insurance. Sometimes to hedge the risk, we go for insurance, that, okay, we'll insure the stock rather than going for hedging for the stock prices. Okay. So insurance is more costly compared to hedging via derivatives. Then hedging also has some tax benefit in various ways. Hedging can can have an effect of increasing after tax revenues. Okay, under IFRS and US GAAP, under both, hedging can have this effect under circumstances, under certain circumstances. Okay, then equity investors may want managers to hedge the risk if investor has concentrated the investment in a specific firm. Okay, so if let's say there is an investor who has invested a lot of money in that specific firm. Okay, so they would want that, okay, you reduce the risk in this regard. Okay, because if something bad happens, I am exposed to it, like firm owned by a specific family or a state. Okay. Next, what we have is the risk appetite. Risk appetite basically describes the amount of types of risk a firm is willing to accept. This is in contrast to risk capacity, which is the maximum amount of risk a firm can absorb. So basically, there is a difference between risk appetite and risk capacity. Risk appetite is that something that you're willing to take. So it's like eating food. Okay, risk appetite, I can tell you. So on a daily basis, what you eat, like 3 chapatis, 1 bowl of rice, 1 bowl of lentils and all. Okay, that's your appetite. But capacity is something that the maximum amount that you can absorb. Like, for example, you go to some place and you feel like, okay, let's say, how much can I eat? Okay, so maybe instead of 3, you will eat 6 chapatis, okay, on that day. But it's not something that you can do on a daily basis, because if you do it, you will have health, you will have consequences on your health. Okay, so you need to consider that. So the maximum amount of risk that can be absorbed is only for special occasions, but risk appetite is something that you are always willing to take. Okay, so it's like a daily appetite of food you are always willing to take. So if you eat 3 chapatis every day, if you eat it, it's not a problem. It's something that you do daily. Okay, so that's kind of thing, appetite. So here you have the basic structure. Risk appetite, this region defines the risk appetite. This is the risk that you want it to be in, and beyond this line you enter the risk capacity region. That means that something you can absorb, of course, but not all times. Okay, not at all times. Now, risk mapping. Basically, risk mapping, risk appetite statement tells a firm what the basic objective is. Like, how much do I need to keep the risk? What is the amount of risk that I need to look for on a daily basis? If something goes beyond that risk level, so action needs to be taken. Okay. Next, it is also important to map out its key risks. Okay, at the cash flow level, and assess its size and timing over particular time horizons. Like, what will be the size of risk? Okay, what time I can see that, okay, that will be the thing happening. Okay, what will be the cash flow level? How much requirement will be there? So mapping the risk properly. Okay, when it arises, how it arises, for what time, at what time it arises. Okay, what will be the amount of risk when it arises? Okay, all these things come under the purview of mapping risk. Okay, risk mapping. Now, again, when it comes to risk mapping and risk appetite and all, you will study about these things in detail in FRM part 2. That is the next part of your FRM certification. There you will have a detailed overview of how risk mapping is done, how risk reporting is done, how risk appetite is prepared, everything. Okay. Next, strategy selection. So you see, you have multiple strategies to manage risk. So once you have your firm, you have risk appetite, you have mapped key risk types, everything and all. Okay. Then you can then decide how to handle each type of risk in the best possible way or in the most efficient way. So if let's say there is a breach in the risk appetite, you need to first assess, okay, what is the amount of breach and things like that. And accordingly, you can do things, okay, like going for hedge or taking an insurance or ditching the plan in altogether or just keeping it in its entirety. Okay, so it depends totally, like based on what your assessments are, the strategy will vary accordingly. Okay. Risk managers must define the most important risk exposures and make some basic prioritization decision that, okay, if this risk is breached, immediate action needs to be taken, and this will be the action. Okay, this will be the start. That's the strategic selection. Okay, if this is the risk, it is not that much important. We can manage it for a while, and so if something bad happens, we can keep it for a while. Okay, and then we can think about it, and then if something worse happens, then only we'll go for any kind of planning and all. Okay, then then once this has been done, then you have to do cost benefit analysis based on various risk management strategies like retain, avoid, mitigate, or transfer. Retain means you are not going to do anything. You will keep it, you will assume the risk in its entirety. Avoid means you will avoid it. You don't want to do it. You will shut down the specific operation, or you will just stop doing that thing for a while, things like that. Okay, avoid. Mitigate, you will try to reduce it. So for example, credit risk, you will try to mitigate it, you will try to reduce it. You cannot avoid it altogether. And if let's say things are not doing good, then you will not retain it in its entirety. You will try to mitigate it in the form of unexpected loss capital, so like loss capital or credit risk capital, or expected loss being incorporated in the what can I say, in the interest rate being charged. So these are ways to mitigate. Okay, then you can transfer can be done through hedging also. Transfer can be done through insurance also. Mitigation is also done through hedging. Okay, when you are not mitigating everything, when you are not when you are actually um, uh, when you do not reduce your exposure completely, okay, through hedging, then it is called mitigation. But if you do a hedge and you transfer all your risk, okay, you have zero risk now, so that's transfer. Another way of transfer is insurance, another way of transfer is securitization. All these ways are ways to transfer the risk from one party to another. Now, right sizing the risk management. So once you have an idea of key risk areas and goals, what are the goals, then you need to make sure that the risk management function is properly developed and it can execute that approach. Okay, whatever approach you have, that means right sizing the risk management. Like whenever, as and when needed, things will be done as per the protocols, as per the strategy that has been decided. Okay. It also becomes more important to separate out trading function from back office and risk oversight functions. Okay, so it's like you cannot keep trading front office collaborated with back office. This should be separate. Okay, and at the same time, risk oversight functions, risk management committees or things like that should also be separate from these two. Okay, all these three should be given some types of independence. Okay. Now, firms using sophisticated risk management instruments and strategies should not become too dependent on suppliers, such as investment banks. Okay, so if let's say you are using some kind of securities or something like that to hedge a kind of risk, or some kind of derivative contract like total return swap or swap in general, or which are a little bit complicated. So you should try to not become dependent on few investment banks. You should have open options all the time. Okay, it's not like, okay, that in like, it's not like our relationship that we have. Okay, so if we select a shop for our daily essentials, we usually prefer to go to that shop only. Okay, that thing should be avoided. And at several points during the year, firm need to conduct board level gap analysis. Okay, to understand matches, like if everything is in line with the strategy or not. Okay, a board level analysis has to be done. Or if there is a gap, if let's say things are not being fulfilled as per the strategy that was decided, so what is the gap there? Okay, and how that gap can be bridged properly. These are the things that need to be done. Then they also need to ensure that risk management function has a clear accounting treatment, whether it's operates as a cost center or the profit center. Things has to be clearly defined. Okay, how accounting treatment will be done for the risk management function, if for the employees, for the losses, for the positions that have been taken, how the accounting treatment will be done. It has to be done properly. Then hedging operational and financial risk. So operational risk is concerned with day-to-day activities like production costs, sales, etc. Whatever you do, making an entry, everything comes under the purview of operational risk. So what operational risks do, they actually affect your income statement, while on the other hand financial risk will affect your balance sheet, okay, like your assets and liabilities. So they have to be hedged in a different way. Okay, if you are hedging operational risk, you should be aware that when you hedge it, it will be reflected in your income statement. So if something goes bad, it will have an effect on your income statement. And when you are hedging for financial risk, it will affect your balance sheet. Your assets and liabilities will be affected because of it. Okay, so here it is given that interest rate and foreign currency risks are critical areas of price risk management for the firms. Okay, so relationship between interest rate and foreign risk is in itself important. We have read covered interest parity. Okay, which establishes the relationship between the interest rates in the different currencies and how it can have an effect on the exchange rate. Okay. So that's the end of the lecture. Just give me a few minutes. We'll start with the new chapter. Okay, that's FMP3. Okay, so now we are going to start with the third chapter, that is the governance of risk management. Here we are going to see how the risk management function works, what are the different rules and regulation regarding the risk management function, the regulatory response and everything. Okay, so let's start this chapter. Now, in this chapter, first we'll understand what is corporate governance. So basically it defines how companies operate. They outline the roles of shareholders, directors, senior management, everything. Okay, it includes defining all the roles and responsibilities. Then high profile corporate scandals basically in the early 2000s basically led to regulatory reforms in the US. And they came in the form of Sarbanes-Oxley Act to improve governance, transparency, and financial oversight, because there were a lot of problems before that. And as I said, it is already said that everybody knows, learn from your mistakes. So these regulators learned from their mistakes and they improved on it. Okay, like, okay, this is something on which they did fraud, or the company was not doing good. So let's have certain regulations or rules which will ensure that these companies are complying to these things. Okay. In Europe, corporate governance reforms were kind of voluntary. In US, it was more like in the form of regulations, but in Europe, it was more of the form of voluntary changes. Okay, like comply or explain. For example, you have to do it. Okay, we have some, you would say in this case, these are not regulations, but these are norms. Okay, you need to comply according to that. If you're not complying, then explain that why you are not complying. Okay. So that was the thing. Now, during the crisis, what happened? A lot of like drawbacks of the already existing regulatory structure and all came into the bright light, that okay, these are the problems that we are facing. More oversight was needed. A lot of things were realized. Okay, so what was the regulatory response after the 2007 and 9 crisis? Okay, and it was classic risk management failure. If you look at 2007 and 9, why in FRM we talk a lot about the global financial crisis? Because it is a classic example of risk management failure, nothing else. Risk management failure. Okay, and that's why it becomes really important to study things from the viewpoint of risk management. Okay, that what went wrong with these organizations. Okay, so it actually revealed the problems with Sarbanes-Oxley Act, which was a light touch approach, and it was found that these types of regulations are really inadequate. We need stronger measures. We need stronger regulatory reforms. Okay, so Basel III emerged, and it was a direct response to the 2007 and 9 crisis, aiming for enhanced systemic resiliency, systemic survival. Okay, they become more resilient, they become more strong. Okay, and what was the Basel III? Composed of first improving capital quality and liquidity ratios, then reducing dependence on short-term funding to counter pro-cyclicality. Okay, we have seen it. So they were using short-term short-term securities to fund their long-term debt obligations. Okay. Now, if something bad happens, the problem was they were not able to finance things in the short-term market, which led to the closure of a lot of financial institutions which were involved into long-term debt financing. Okay. Then macro potential overlay. They gave certain things. They said that, okay, there are certain things that you need to comply. First was 3% leverage ratio. Then total loss absorbing capital standards. Okay. You need to define your capital standards for absorbing total loss, not a part of loss. Okay. Counter cyclical capital buffer. If there is a counter cyclicality, you need a capital buffer. Where do you get it? How do you get it? You have to plan everything and you have to put everything in place. Then central clearing and trade reporting for OTC derivatives. That was made mandatory, that you have to do central clearing even in the OTC market. And standardization of product was that. And if the trade is standard, products are not standard, then at least you'll have to report the trade. Whatever you do, even if it's standard or non-standard, you'll have to report the trade. Okay. And finally, capturing systemic risk and tail events in risk modeling and stress testing. Okay. So risk modeling, they moved towards from VAR to expected shortfall, capturing the tail event. Systemic risk came in the form of stress testing, scenario analysis, where everything in the market was brought into turmoil and they were asked, banks are actually asked to tell us what they're going to do in this regard. Okay. Then BCBS, Basel Committee for Banking Supervision, also issued governance principle for banking industry in October 2010, and then it was revised in 2015. It defined the roles of board risk committees, senior management, CROs, internal auditors, everybody. That what should be the role and responsibilities. That's really important for governance because there should be no conflict. Okay, so if there are two parties on the, if let's say there are two people who have a say, equal say on the same topic, so there can be disagreement, there can be problems. Okay, so a clear governance structure has to be there, like what person will do what. It has to be defined clearly. Okay, it's like a constitution for the organization. They will go by this book. Okay, so if in this regard the suggestion or the recommendation of this person will be considered of utmost importance, then that has to be done. Okay, nobody else can interfere with that. So for that, it's really important that you are defining the roles of different aspects, different stakeholders of the organization, internal stakeholders. Then for handling market risk, they again revised it in 2015 and brought in fundamental review of trading book, which actually helps us to understand market risk. Okay. Then another response was the Dodd-Frank Act. Okay, which was signed in July 2010. And this act actually aimed in improving both consumer protection and systemic stability. Okay. So in Europe, however, all these things, what happened were from were for US and the rest of the world, I would say. But in Europe, the approach was slightly different. Okay, a new approach to banking separation, which was SREP, supervisory review of evaluation process, and evaluation process was taken into place. Okay, where internal capital adequacy assessment process, ICAP, and ILAP, internal liquidity adequacy assessment process, were the two components. Okay, so they need to show that, okay, what is your internal capital adequacy? How do you assess it? Okay, it was one part, and then internal liquidity adequacy assessment was the two parts. Okay, that were able actually put in place to ensure the resilience of the banks at the time of crisis, because these are the two things that actually help you survive the crisis: capital and liquidity. Okay, then if we talk about Dodd-Frank Act, what was the different aspects? First, resilient plan or living will. So by company has to define that if it is going to go bankrupt, then how things will turn out. Okay, who will get what, how things will have to turn out. So it's like a living will. Okay, resolution plan, that okay, this is something that we plan. Then strengthening Fed using macro potential supervision. The macro potential overlays we have read what was it. Okay, so it gave more power to the Federal Reserve to control the banks, to supervise the banks more properly. Then ending too big to fail through orderly liquidation authority. There were certain entities which were considered too big to fail. If they failed, it would have led to systemic crisis. Okay, like AIG, not Tata AIG, AIG. Okay. At the time of crisis, AIG was actually bailed out. Somewhere around more than $100 billion of bailout package was given just to AIG. The reason is pretty simple. AIG sold a lot of CDS. Okay. In the hope that, okay, nothing is going to go bad. And when the crisis unfolded, AIG had to pay a lot of obligations. Okay. And if AIG had defaulted, it would have created a domino effect. Like AIG had insured almost all the financial industry at that point of time. So they were under a huge obligation. Okay, so that was the problem. That was ending too big to fail. Then more regulations were brought into derivatives market, be it OTC or exchange derivatives market. In fact, exchange derivative market were quite more or less intact. It was the OTC market that suffered a rule. Then there was Volcker rule that was brought into the picture. Okay, and then you had creation of Consumer Financial Protection Bureau to protect the interest of consumers who are the end users of the bank. Stress testing, and in stress testing you had multiple ways, like top to bottom approach unfolding over several quarters. Okay, like step by step things are unfolding, and it will go on for many periods, like maybe year or so. Okay, then focus on the effect of downturns or risk types, like what will be the effect of, like, okay, certain risk type moves in this direction, or let's say there is a downturn. Okay, GDP starts to fall, inflation starts to increase, all these things. Okay, then a stress testing framework was designed properly. If you remember, there are multiple stress testing framework, like CCAR are there, and other things are there. Okay, for banks with capitalization between 10 billion and 50 billion dollars, and for banks with capitalization more than 50 billion dollars, they have different stress testing framework that was developed. Okay, then computationally demanding approach. It was made more computationally demanding, because now you have to do a lot of things. You have to do a project a lot of things. Okay, and also base your projections on by some solid foundations. Okay, solid economic background also. Okay, and then holistic approach, like overall, we want to see stress testing is not the only part. You have scenario analysis, you have reverse stress testing, you have ad hoc tests coming into the picture. So as to get what will happen in the worst case scenario. Then let's talk about the best practices in corporate governance. What are the best practices? So for the board, the best practices include independent members with business knowledge. So the board members should be independent, and they should have the knowledge of the business. Then they should consider the interests of both the debt holders and the shareholders. They should address agency problems and control compensation scheme. Compensation scheme is yet another problem that was actually a disaster if you will study the 2007 and 9 crisis. Okay, we'll come to that. Oversight of executive management to understand risk undertaken. Okay, executive management should be overseen properly by the board. They should be knowledgeable enough. They should be capable enough to understand the risks that are being undertaken. Okay, then introduction of a CRO to align corporate governance with risk management. Chief Risk Officer. That's really important. Then independent from executive teams, and CEO should not chair the board. Okay, they should be independent from executive teams, the board, and CEO should not be the chairman of the board. Okay, CEO should be separate person. However, in most cases, you will see that the CEO is also the board member. Okay, but that should not be the case. Now, best practices, again, if we talk about the board, there are other things also. Assess risks and rewards from the perspective of risk management we are talking now. Okay, that in the previous slide we had from the perspective of corporate governance. If what are the best practices for corporate governance the board can incorporate. Now the best practices for risk management, what board can do. Assess risk, rewards, and define risk appetite. It's the primary objective of board. Board has to assess risk, rewards, and board needs to define risk appetite. Of course, in consultation with the risk management team, and they have to be pretty well aware of risk management. Okay, alignment between risk management and strategic choices. They should always consider when risk when considering the strategic, when making a strategic decision. Oversight and risk transparency. There should be a clear oversight. Board should clearly oversee what is being done, how it is being done, and the risk transparency should be there. That means whatever the risks are being shown transparently and are being addressed transparently. Okay. Then set up an ethics committee. Ethics committee should be set up, which ensures that things are being done ethically. Verify the accuracy and reliability of risk information. Whatever risk information comes in, it's not always that you should believe it. You need to verify its accuracy and how reliable this risk information is. You need to understand all these things. Then establish separate risk and audit committee. Usually what happens, audit committee does some kind of risk assessment. Okay, but risk committee and audit committee should be separate from one another. They should not be the same department. Then evaluate performance metrics and compensation. That's something that has to be done. Like performance metrics, how performance is being calculated. Okay, how performance is being measured, that a certain manager or a certain personnel has done a good job. Okay, for that you need to take into consideration a lot of things. Then you have the risk advisory director. So what are the roles and responsibility of risk advisory director? It enhances efficiency and effectiveness of risk and audit committee. Okay. Then next, supports audit committee during meetings, provides an independent view on risk reporting, that what this risk advisory director thinks about the risk report that is being presented. Regularly meet with the management. They meet with the management and they take into they discuss like what is the risk, what is happening, what risk management team is saying. So it's like a bridge risk advisory director. They advise risk management function also. They observe management's business conduct. They see that how the business is being done. And of course it is being done through regularly meeting with the management. Offers expertise in corporate governance and risk management practices. They are experts, like they are risk advisory director. Okay, so they're expert in risk management and corporate governance. So they advise that okay, what can be done for risk management, proper risk management, and proper risk corporate governance. Then they provide academic insights on critical business risks and the overall business. Whenever a new strategic decision has to be taken, let's say, okay, they can provide insights that okay, what can be done, because they have huge knowledge base. Okay, in this regard, they are the experts in this field. And finally, examine the interface between corporate governance and risk management. They see that how corporate governance and risk management functions are interacting with one another. Okay. Now, risk appetite in business activity. So board supervision of business strategy and risk appetite. Okay. So what does it, how board supervises? So basically, board oversees management in developing business strategy. It considers downside risk of any strategy. It defines logical relationship between risk appetite and business strategy. Okay. So board, what the board can do? Then approves risk appetite annually. It is the board's duty. Then what is the role of senior committee in this regard? Senior risk committee, it implements and oversees risk appetite framework. It implements the risk appetite framework, whatever has been decided by the board. It oversees it if everything is going fine or not. It sets parameter for financial and non-financial risk. There are certain parameters set, certain levels are set, certain limits are set. Okay, like what are the parameters that will be considered? Okay, then they may establish subcommittees for each risk type. So there is a central risk committee, then they may establish market risk committee, credit risk committee, depending on the vastness of the risk type that they are handling. Okay, they develop risk limits for each business and associated risks. They define risk limit, tier 1, tier 2 risk limits, etc. They set standards for metrics approved by CRO and internal risk committee. Okay. They report back to board and recommend prudent total risk based on set risk limits. Okay. They always report back. Okay. It's the role of risk committee. Then finally, monitoring risk limits, continuous monitoring to ensure compliance. There has to be continuous monitoring. It's not like a one-time exercise. You have to do it continuously. You need to utilize metrics like VAR and expected shortfall for verification also. Okay. To verify if risk limits are being breached or not. Okay. Next, compensation committee, incentives and risk taking. That is really important. Compensation should be aligned with risk adjusted return on capital. It's not like, okay, if somebody has made more sales, they should be given altogether more incentive. There is a problem with this structure. Okay, one might say, why not? But the thing is, just to during the 2007 and 9 crisis, what happened? There were brokers, okay, dealers who were given commission if a new mortgage was issued by the bank. Okay, if they issued it. So what happened? In order to make more and more commission, because the compensation was directly linked to the number of loans, not the quality of loans. That means the loans were not adjusted for the risk that was being taken by the bank. Okay, so the moment a loan was initiated, the dealers got a fat commission, and that made them really happy. So in order to enhance that, what they did, they started giving out loans. They started helping get loans to those people who did not even qualify to get a loan. Okay, just to get the compensation, because for them it was like, okay, we get the compensation, end of the story, I'm out. Okay, it's the attention of the bank now, how they will collect the money, not mine. Okay, so here what is actually happening is that it is giving rise to adverse selection. Okay, so the banks need to have a compensation structure, incentive structure, which avoids adverse selection. So maybe there is a manager who does exceptionally well in a financial year. They do a good business, but let's say that business is not feasible in the long term. So in the first year, that manager gets a huge commission and he leaves the organization, he or she leaves the organization. And after some time, banks start to see losses in those projects in which the manager had invested. Okay, so these things should be attached. The incentives should be attached to the performance of the underlying investments as well. Okay, that's what we call compensation should be aligned with risk adjusted return on capital. In many places, regulations mandate public firms to create an independent board compensation committee, which will determine the executive pay and align it with the long-term shareholder goals, not short-term profits. Okay, so it should be aligned, more aligned. So what could happen done here? So instead of giving out all the commission in one go, it should have been made that, okay, initially you will receive only 10% of the commission. Then after a year of no default, you will receive another 30%. Then after one more year of no default, you will receive another more. In the case of managers and all, another option to incentivize can be ESOPs, employee stock options. Okay, where if you have done huge business for the company this year, then you do not get, let's say you're entitled for 100 crore incentive. So only 10 crore you get in cash, but the rest 90 crore you get in the form of employee stock options. So that means in order to encash it more, you need to ensure that the company is doing well in the long term also. Okay, not only the short term profits. So that's how compensation structure can be decided. And for that, separate compensation committee has to be created. There is regulations in certain places. Okay, like what are the G20 recommendations in this regard? First, elimination of multi-annual guaranteed bonus. There should be no multi-annual guaranteed bonus. Okay, annual guaranteed bonus should not be there. It should be eliminated. Share-based remuneration, as I said, in ESOPs. Then deferred compensation. The first one, 10% you will receive this year, another 30% after 1 year or 2 years, and so on. Okay. Then clawback provisions. Clawback provision means if, let's say, you have made commission this year, and after some time the businesses that you did actually start performing poorly, so we can hold on to your compensation, will not give out. Okay, will not give out any extra. So let's say a dealer gave a loan to a person who did not qualify for the loan. Okay, so what happens after a year? The person defaults. So whatever the remaining compensation is can be shall not be given to the dealer. Okay, these are the things that can. And then limitation on variable compensation. Variable compensation should be limited. It should not be of the certain percentage of your base salary. Okay, you should not have too much of a variable compensation. Now, coordination between structures. So how the coordinations? Risk committee of the board approves risk tolerance each year. Risk committee of the board, that means board in general. Then senior risk committee approves risk tolerance, stress, and performance limit each year. Reviews business unit mandates and new business initiatives. That's the objective of risk management committee. Then you have the senior risk committee. What they all do, the other thing that they do, delegates authority to the CRO. They say that, okay, these are the powers of the CRO, and holds additional authority in reserve approved by the risk committee of the board. Okay, so senior risk committee gives a lot of power to the CRO, but at the same time, they have additional authority reserved for the committee itself, which is given by the risk committee of the board or the board risk committee. Okay, then CRO, what is the role of CRO? Does independent monitoring of limits. He or she independently monitors what the limits are, how they are doing, and how many times they are being breached. May order position closed or reduced from market, credit, or operational risk concerns, depending on how the limits are being breached. Okay. Then head of business units. So these are the hierarchy that you're seeing. Head of the business units share responsibility for risk of all activities of that unit. Then business unit manager responsible for risk and performance of the business must ensure limits are delegated to the traders. So that's the whole water flow, you will say, from the top to bottom till the business unit manager. What are the different roles and the different responsibilities of these members? Okay, then there is an interdependence also. Like it's not like all everything is dependent, one cannot interfere with other. So for example, if we talk about senior management, it sets the business level risk tolerance, designs and manages policy, it evaluates the performance. Business line, what they do in return, takes on and manages exposure to approved limits. So senior management delegates their decision to business line, and they do things accordingly. They verify the valuation also. Then finance and operation, they set and manage valuation and finance policies. They oversee official valuations, including independent verification. They manage support, analyzes. They manage and support, analyze required for support analysis for business planning. They do all the things. Like these are the workforce, okay, that will do actual things. Okay, senior management, business line managers, they just give the directions that has to be done and reporting back. Okay, then risk management, they manage policy development and implementation. They monitor limits continuously, so they work very closely with finance and operations. Okay, they control model implementation risk, give senior management independent risk assessment. Okay, so how it happens? Senior management delegates to business line. Business line delegates to finance and operations. Finance and operation work closely with risk management, which finally gives their input to senior management. So this whole structure is there. So there is a clear interdependence. If one of them is not there, then it will create problems for the organization. Okay. So with this, we have completed the third chapter. Just give me a few minutes. I'll start the next chapter. Okay, so now we are going to start with FRM4, that is credit risk transfer mechanisms. Okay, so you see, when we talk about banks, the most important types of risk that the banks are exposed to is credit risk. And they need to have a way or certain tools to transfer this risk from one party to another. At times, it may be needed. Okay, like one way is OTD. Then there are other ways also. There are ways which is off the balance sheet or on the balance sheet. Okay, so one way is to remove the credit exposure complete in its entirety from your balance sheet. Another is to keep it on your balance sheet and then manage the risk accordingly. Okay. So when you keep it on the balance sheet, it means on the balance sheet management. When you remove it off the balance sheet management, you completely get rid of the credit exposures that you have. So OTD is like you are removing the credit exposures from your balance sheet altogether. Okay. And using instruments like TRS or things like that, total return swaps, or let's say using swap contracts or things in this way. So they reduce, you don't remove the assets from your balance sheet. You keep it there, but then you manage it separately. Okay. So we'll see the different mechanisms that are used. So first, if we talk about traditional credit risk mitigation, so what was the way? So banks had many ways to reduce the credit risk. Okay. And it was done on an individual basis and on an aggregate basis as well. So what were the credit protection techniques? First, purchasing an insurance, then netting the transactions, margining, requiring collateral, termination or put option was there, agreement, reassignment, that okay, something bad happens, it will be reassigned to someone else. Okay. Syndication. All these things were are traditional techniques that are still used today. I'm not saying that they are not used today. They are not bad. Okay. They do help to an extent to reduce the credit risk capital. But now we have more advanced techniques that can be used. And we are going to see that. Okay. So in syndicate, you have two ways: firm commitment and best efforts. Okay. Now, credit derivatives. These are the recent ways that have been developed to reduce the credit exposures, in which we transfer the credit risk from one party to the another. Okay, they are OTC financial contracts, over the counter market, financial contracts, and they shift credit or default risk from one party to another without actually transferring the assets. So derivatives, you are transferring the risk, not the asset. Okay, using credit derivatives. Credit derivative value depends on the credit worthiness or credit events of the referenced party. Okay. So credit worthiness of the asset or certain credit event which will lead to a credit derivative having certain value. Maybe default probability increasing or exposure at default increasing, loss given default increasing. All these things can be a factor, contributing factor. Okay. Now, what is a credit event? So, for example, failure to make required payment, the most simple credit event. That's one. Then you have restructuring that makes any creditor worse off. Sometimes when there is a technical default, like for example, especially in the case of countries, if a country default on their debt obligations, they are not like that the country can be sold. It's not possible, right? So what is done in that case? The debt is restructured. Maybe its value is reduced, its time to maturity is increased, coupon payment may be slightly reduced. Okay, so these are the things done, that is restructuring, and that can lead to a scenario where the creditor's position, the people who had invested, who had lent money to that country, can have effect. Okay, so that's what we call restructuring. Also, in case of financial institutions, restructuring is possible if the entities are too big to fail. Okay, they are too big, and if let's say they default, it can have serious consequences, so restructuring can be done. Then invocation of cross default clause. Okay. And finally, you have the bankruptcy. So these are certain examples of credit events. Okay. That can be like, okay. So these are the certain default clause. Like there are default clause, cross default clause, like not actual default, but if let's say there is a downgrade in the credit rating, that can also act as a credit event. Okay. There is an increase in the probability of default, that can also act as a credit rating or any other thing. Okay. Now let's talk about the credit derivatives that are used in this purpose. So first is the CDS credit default swap. We have already studied it, what these are. And we'll see slight detail also. First to default puts, collateralized debt obligations, collateralized loan obligations. In fact, debt and loan obligations, CLO and CDOs are quite similar, the structure. Okay. Or the only difference is in the underlying, in the nature of the underlying. Then you have total return swaps, that is TRS. Then you have credit spread options. And then you have CLN, credit linked notes. Okay. So let's see some of them one by one. So first, let's understand what is a credit default swap. So here, let's say you have a reference portfolio, and on this portfolio, party A is there, and then there is party B. Party A owns the reference portfolio, owns this asset. So party A says that, okay, this is the reference portfolio. The credit derivative that I'm creating is based on this portfolio. Okay. Then what happens here? Regular fee payment until the credit event. So party B says, party A says to be that, okay, this is the reference portfolio. I want credit protection against this portfolio. And for that, what party A does, it pays a regular fee to party B until there is a credit event. If there is no credit event, then fee goes to win. But if there is a credit event, then in that case, what will happen? At the time of default, party B will make the default payment in the case of credit event. Okay, so whatever the loss party A incurs in this reference portfolio will be given by party B to party A. Okay, that's the basic example of CDS. If, in other words, if that person loses money, you will give me this much. Okay, that's the kind of thing that I'm talking about. So that's CDS, and the most simplest form of, most simplest way to transfer the credit risk. Okay, so here, since party A is transferring the credit risk to party B, so party A is called the seller of credit risk and party B is called the purchaser of credit risk. Okay. Why? Because party A has nothing to worry about. Default payment in the case of credit event, who will give? Party B. Okay. Protection buyer. And that's why, and in other words, party A buys the protection. So party A is the protection buyer, or in other words, you can say the credit risk seller. Party B is the protection seller because party B says that, okay, I'm giving you the protection. So party B is the protection seller. But at the same time, what kind of protection? I'll take upon all your credit risk. So in other words, party B is also a credit risk buyer. This party B can be AIG. Okay. This party A can be any bank, any financial institution, or some speculator who is betting on the credit default swap. Okay. Then first to default puts. What are these? Let's understand. So let's say you have a portfolio of 4 high yield loans and they are rated B with small correlation. Okay. They don't have too much correlation. So if one of the bond defaults, it will not affect drastically the default probabilities of other bond in the portfolio. $100 million nominal value each. Okay, each has $100 million nominal value. The coupon rate is LIBOR plus 200 basis point, and the maturity of this portfolio is 5 years. Okay, so this is a portfolio that will be referenced. Now, protection buyer. Okay, let's say this is the portfolio owned by the bank. So bank now wants to buy the protection, or in other words, wants to sell the credit risk. Okay, so there will be a protection seller who is the dealer, and this seller is considered the buyer of the credit risk. Okay, protection seller is the seller of protection and buyer of risk. That's how you remember it. Okay, then what they will agree, they will say that, okay, I'll pay 400 basis point on $100 million. That is 100 basis point for each. Okay, the buyer says, I'll pay $100 basis point for each of the loan. That is 4 loans are there. I'll pay 100 basis point for each. So in total 400 basis point. Then protection seller says that there are 2 scenarios. If there is no default, I'll pay nothing. So basically this payment that is being made is kind of like a option premium being paid to the dealer. Okay, this option premium. Now, if there is no default, there will be no payout from the protection seller because there is no credit risk to take upon, right? But if there is a first default, only for the first default, in the case of first default, that's why the name first to default puts. It's a variation of CDS. Okay, where all the defaults are to be considered. Here, only the first default has to be considered. Okay, then in that case, the protection seller will pay the par value of the defaulted loan. Okay, so there were 4 loans. Let's say one of the loans defaulted. So in this case, the par value of the defaulted loan, $100 million, will be paid by the protection seller to the protection buyer, from the dealer to the bank. Okay, now the condition here is that the loans in the portfolio should have a small correlation. Because in that case, what will happen? If one bond defaults, the probability of default of other bonds will increase, thereby leading to a worse position for the bank. Okay, now why would anybody go for this structure? Okay, why would any bank go for this structure? Why not insure the whole portfolio? Of course, the cost has to be considered, right? And the nature of the portfolio itself. And what happens? This protection seller pays the defaulted par value of the defaulted loan, and the defaulted loan is then transferred directly to the dealer. So let's say bond one defaulted. So what protection buyer gets? The value of the bond one, face value, and the bond and the protection seller, then protection buyer then transfers bond one directly to the protection seller. In case of CDS, there was no transfer involved. Okay, there was just value being paid. That this is your default loss. I'll give you the value of default loss, amount of default loss. Okay, here what is happening? The protection seller buys the loan altogether. Now say that, okay, you don't worry. You get the face value, now you go. I'll see what I have to do with the defaulted loan. Now, whatever they are able to recover from it, and the difference will be their cost. Okay, in this case. Now, if more than one loan defaults during that period, the bank is compensated only for the first loan that defaults. Okay, only for the first loan. As the name suggests, first to default puts. Then you have the collateralized debt obligation, and collateralized loan obligation also have a similar structure. Only the reference portfolio will change. Okay, so let's say you have originating bank where assets are there, loan, bond, loans, etc. Okay, so if it is bond or let's say mortgage, etc., it is collateralized debt, bonds, etc., then debt, loans, then loan obligation, CLO. Okay. Now let's say there is an SPV issuing vehicle which has a trustee. Okay, and then these originating bank will sell this asset completely to the SPV. Asset is sold to the SPV, and SPV, then how do SPV pay back the banks? So they issue notes. Okay, so they issue notes, and the note proceeds are given to the originating bank. How the notes are issued? So first they will issue a CDO. Okay, it will be bifurcated into multiple tranches. Senior tranche, AAA. Generally, it comes with a surety wrap. That means if anything bad happens, if there is a default, the SPV will pay anything that is short. Okay, that if there is a less payment involved, let's say it is promised that 4% will be received, and let's say 3.5% is there and 0.5% is the loss happening. Okay, so SPV will ensure that 0.5% is SPV is giving it from their own pocket. That's the surety wrap. Then you have B note A. Then you have mezzanine tranche, which is a BB note. Then you have the junior note, which is equity piece. Okay. So these sale proceeds are then note proceeds are given back to the originating bank. Okay. These are the tranches that we know. Okay. Issue proceeds. So here, these are issued, and the proceeds, who get the proceeds? SPV. Okay. And these are based on risk and coupon increase. So here, as you go down towards the mezzanine and junior note, that is equity, risk keeps on increasing, and that's why the coupon rate also increases accordingly. Collateralized debt obligation have a similar structure. The only difference is in case of bonds, you will have the loans. Okay, CLOs. Now let's understand a total return swap. In total return swap, the total returns basically tracks returns on underlying assets like bonds or loans. They offer benefits similar to CDS, but differ in that TRS transfer both market and credit risk from seller to the buyer. Okay, so CDS is a way to transfer credit risk only. But the total return swap is a way to transfer both market as well as credit risk. What happens here is that I am keeping it on my balance sheet, but I'm using TRS. All the return that I'm earning on this asset, I'll transfer to the other party and I'll get something in return. Okay, total everything, even the change in the value of the bond is something that I will transfer. It will be transferred, exchange between the parties involved. So let's see the structure. So there is an underlying asset. So bank, which is the seller of credit and market risk. And there is a dealer who is the buyer or buyer of credit and market risk. Okay. Now total return on this underlying asset, including any coupon plus appreciation in the value, will be transferred from bank to the buyer on this asset. So let's say there is a bond, it paid a coupon of $5, and over this 6-month time period, let's say the value of the bond increased by some amount. So that increase in the value is also transferred. Okay, or decrease in the value is also transferred. So in the case of bank, increase, any appreciation will be transferred. Okay, and what the dealer bank will give? Dealer bank will agree that, okay, there will be some LIBOR plus a spread, and any depreciation in this value, in the value of the underlying asset. If the value of the underlying asset depreciates, then whatever the depreciation is, I'll pay you. So you see, depreciation of prices, market risk is being covered clearly. Coupons is covered through LIBOR plus a spread. Okay, so credit risk, that is LIBOR plus spread, and depreciation, that is market risk. Everything is, this bank is protected against everything, that is credit as well as market risk. Okay. Now let's see what happens. What are the cash flows? So during the life of the option, during the life of the underlying asset, at different time periods, bank basically receives the LIBOR plus the spread, not any appreciation, depreciation at that point of time. Okay. During the life. Okay. But at the end, there will be. Okay. So don't worry. When the TRS expires, not the end of the life of the underlying asset, but at the expiration of the TRS. Okay. Total return swap. So let's say there is a bond with 5-year maturity and the total return swap is for 3 years only. So at the end of 3 years, what will be the transaction? We'll talk about that. And during this period, bank pays the coupon. Whatever coupon the bank is receiving from this asset, it is completely being transferred to the dealer. Okay. Now let's say TRS maturity comes in T. So at that point of time, what will happen? The bank will receive, or in other words, the dealer will pay LIBOR plus spread. Okay, LIBOR plus spread plus any depreciation if any. Okay, plus depreciation if any. So let's say over the 3-year period, the value of the underlying asset has decreased from 100. Now it has become 98. So there is a depreciation in the value of $2. So this $2 will be paid along with the LIBOR and spread. Okay, if there is no depreciation. Okay, if there is no depreciation, then what will happen? The net payment is actually LIBOR plus S. Okay, only if there is no depreciation, LIBOR plus S, bank receives. Okay. Now, in the case of bank paying total returns, at the final, coupon will be paid. Okay, coupon will be paid plus any kind of appreciation. Okay, plus any kind of appreciation in the value. Who will pay? The bank will pay. Okay, so that's the structure. Now, what are the usefulness of credit risk derivatives in risk transfer? First, they are off-balance sheet instruments. So you are not required to show these credit derivatives on the balance sheet separately. Okay, there are off-balance sheet instruments and facilitate the transfer of credit risk between two counterparties without having to sell the given position. There is no need to sell the position, sell your assets that are there on the balance sheet. There is no need. In OTD, the assets are sold actually. Okay, then they also permit the isolation of credit risk and transfer that risk without incurring any funding or client management issues. Third, you have risk transfer and securitization basically enables institutions to effectively tailor pools of credit risk exposures by facilitating the sale and repackaging of risk. Okay, so basically it's a good thing. OTT model is not bad. It was the people who used it who were bad. Okay, OTT is an excellent model. Like if you have a risk of $1 million and only one entity is taking it, it's huge. Okay, but if that risk is distributed among 1 million people, so now every person is exposed to $1 of risk and it's literally nothing. Okay, so it will be absorbed. It's like a shock absorption. So the wider the base, the better it is. Okay, it was the objective, but later on what happened there also you saw the concentration. The banks engaged themselves. They themselves actually got involved into buying those securities, which should not have been done. Now, when properly executed in robust, liquid, and transparent market, they contribute to the process of credit price discovery. That means they clarify what is the market value of the credit risk. In other words, that's what we call credit price discovery. Now, the mechanics of securitization. First, what is there? There is an asset pool, which can be asset-backed, asset-backed securities, corporate investment grade bonds, leveraged loans, mortgages, whatever. Okay, so there is an asset pool, and this asset pool is, of course, through an originator who originated these assets. Then what happened? A true sale is done between the originator and the SPV. This is actually transferred from the balance sheet of the originator to the SPV completely. And SPV is the issuer. Sale is done. Now, proceed from the sale of assets will be given back to the originator. Okay, once these assets will be sold in the when they are whatever the price is agreed, originator will receive that price from the SPV. So there is an actual sale happen. Okay, then SPV will go for credit enhancement like ensuring capital requirements and all. So credit enhancement is done for the SPV. Okay, and then securities are issued. Structuring is done. Tranches are decided. AAA, mezzanine. Okay, and then a lower tranche. Okay, all these tranches are decided. And then once the notes are issued, proceed from the sales note, get back to the SPV. Okay, these proceeds go back to whom? To the SPV. Now, creating credit tranching, Class A notes, Class B notes, Class C notes, and Class D notes. So A, B, C are usually sold, and D is retained by the SPV. Okay, that's how the structure works. And finally, Class A notes is sent to the investors. All the notes are sent to the investors except for Class D notes. Okay, equity or excess spread that is retained by the bank itself. So the first hit of losses is taken upon by the SPVs themselves. Okay, or the shareholders, I would say, of the SPV. Now, from buy and hold to originate to distribute. You see, initially we know that there was a strategy called buy and hold. So banks would usually issue loans and they will keep it on their balance sheet and try to manage the risk around it. Okay. Now there was a shift from buy and hold to originate to distribute. So banks originated the loans and then they sold it to SPVs, where further it was distributed among a larger base of investors so that the credit risk gets reduced drastically. The effect. Okay. It's like the same thing. So for example, a 10 how should I say that, a 10 kg weight falling on your head, you will die. But if the same 10 kg weight is in the form of is a spread out, like in the form of in the form of a bag which contains 10 kg of I would say cotton. Okay, so its area will be huge. Okay, it is more spread out, so that its effect will be little less, very less on individuals. Okay. Now, financial innovations like securitization basically enhanced this process. Okay, they helped prosper the originate to distribute model. This change was partly driven by Basel requirements. Also, capital requirements were more and more strict, becoming more and more stricter. That for capital risk, you need to take in more and more you need to keep in place more and more capital. Okay, so the best way was to don't keep loans in your portfolio. Okay, if you remove it, you don't have to keep a lot of money as credit risk capital. Okay, and also at the same time, they got immediate earning in the form of commission by selling the assets for securitization. Okay, so there were multiple benefits. Risk charge was decreasing. Their balance sheets was getting freed up. They had more capital now left to go for aggressive lending, and they were also getting some fees also. Okay, for so that they are able to cover up any cost incurred for issuing the loans. Okay, now the shift towards OTT model, it basically offered financial industry many benefits: greater capital efficiency, enhanced funding opportunities for the banks, wider array of investment for investors, like CDOs were there, CLOs were there. A lot of things came into the market. Okay, and then finally you had expansion of available credit and product options for the borrowers. Now, since the banks have a lot of more money and their main business activity is to lend money, okay, from the deposits, with the money they get from the deposits. Okay, so they now go for active lending. Okay, so like, no, I want to give out more loans. So more available options for borrowers. However, actually it had its own problems also, and these problems were, um, first was moral hazard, then you had misaligned incentives, then you have lack of transparency in securitization, what was being done to ensure that the tranches will not default. Okay, mezzanine or superior tranches will not default. Okay, so there was no transparency. Some models were there, sophisticated models which credit rating agencies were also not able to understand properly, and ratings were given abnormally high, which actually was visible during the time of crisis. Okay, then poor securitization risk management. When the securitization was done, risk management was very poor for that also. Over reliance on credit ratings, and yeah, that was all. Okay, so that's the end of this chapter. So now let's have a break of half an hour, and then we'll start with the remaining half of the topics that are left. Okay, so don't leave the meeting, stay in the meeting. We'll start after half an hour. Yes, so let's start with the modern portfolio theory and the capital asset pricing model. That is the fifth chapter of our today's discussion. Now, in this chapter, we will study the modern portfolio theory, the assumptions related to it, the mean variance framework, and one thing that I have already taught you guys in the crash course in VRM chapters, that is efficient frontier. So we'll not delve into the aspects of efficient frontier in detail. Our focus will be mostly on capital asset pricing model and its application. After that, we'll also see some performance measures, that is like Sharpe ratio, trainer ratio, information ratio, Sortino ratio, all these things. What are these things? Jensen alpha. In brief, because in the examination, you can expect direct questions from these aspects. Okay. So We'll see what these things are, and with this we'll conclude our chapter. Next, we'll start with then arbitrage pricing theory and multi-factor models. Again, that's really simple, not too much in detail, but only the exam specific concept that I'll cover. Okay, so without wasting any time, let's start our session on FRM 5. So in this chapter, first we'll understand modern portfolio theory, and modern portfolio theory has certain assumptions. And first thing, it assumes that if there is a rational investor, okay, so he or she, whoever he is, whoever that person is, will evaluate the potential portfolio allocations. Okay, that means the money will be allocated based only upon the mean and variances for the expected rate of return distributions, like mean and variances of the rate of return. That's the basically the foundation of mean variance framework. Okay, so if you have to make an investment decision, you will solely consider the mean and the variance of the assets available in the market to make asset allocation. That gives you the best possible set of asset combinations which will have the optimal returns. Okay, given the constraint on the number of assets that you have. Okay, so that's a foremost assumption of a rational investor in the modern portfolio theory. It also assumes that capital markets are perfect, which in reality are not. We have serious disequilibriums and disequilibriums that are sustained over period, not short term. Okay. And it says that there are no transaction costs involved, no taxes involved. Again, that's not true. All traders have costless access to available information. Again, it's not true. All the available information are not available. All the information are not available cost free. And perfect competition exists among the market competitions. Again, that's not true. However, if it has, one might say that if it has so many assumptions which are restrictive in nature, then why in the first place people are reusing it? But the fact is, no matter its limitations, it still finds a lot of use in portfolio management, and it basically is the foundational stone of portfolio management. Everything starts from here. Then it further assumes returns are normally distributed, which can be said to be true if you are talking about a short time horizon like daily returns or something like that. But over longer periods, returns are usually not normally distributed. Okay. Then the thing is, investors we seek to reduce variance of the portfolio returns by diversifying their investments. Okay, so if you are an investor and you want to reduce the risk on your portfolio, in other words, the variance or standard deviation, so what you're going to do is that you will be diversifying your investment. That means you will not put everything in one asset. You will find different types of asset, invest in them in such proportion that your standard deviation reduces to the lowest possible level for the given level of risk also. Okay, for the given level of reward, your risk is reduced to a lowest possible level. Now, according to Markowitz, who gave the modern portfolio theory, the level of investment in particular assets should be based upon the asset's contribution to the distribution of portfolio's overall return. Okay, and this is basically measured by the mean and variance. Okay, theoretically, if you say portfolio diversification actually help us to reduce the individual asset exposure, and that too at zero cost. Nothing has to be done. Just keep on adding assets, and you will be able to reduce the asset exposure. And this is true, in fact, if not 100%, then at least to a larger extent it is true in the real life scenarios also. And people do diversify their portfolio, okay, because it helps them to reduce unsystematic risk or idiosyncratic or firm specific risk to a greater extent. Okay, and it does not mean that if you have to diversify the systematic risk, then you'll have to go for just give me 1 minute. Okay. Yeah, so let's move forward. So as I said, in this case, the thing is, in practice, what happens? So if you have to diversify a lot of risk, it's not necessary to invest in the complete market portfolio. What you can do, you can select 20, 30 stocks from different industries, from different capitalizations, which sufficiently, I would say, reflect the market. Okay, which approximately reflects the market. And that will be sufficient enough to reduce the firm specific risk exposures that you might have in your portfolio. Okay, so that's what happens in practice. Okay, however, theoretically you can reduce it to zero at zero cost, and here also there is no cost involved. Practically, if you'll see, like if you're adding an asset, it's just the investment you are making. There is no extra cost needed. Okay, like hedge position or things like that. Okay, now A reduction in risk should result in lower expected return. And once you have established the fact that, okay, there is risk reward relationship fairly established, then if you reduce the risk, then the reward should also get reduced. If you increase the risk, your reward should also get increased. In simple terms, if I talk about the total risk on any portfolio, then it is basically the combination of systematic risk, which is the macroeconomic risk, or you can say which affects the economy overall. Okay, systemic risk, plus the unsystematic risk, that is the firm specific risk. Okay, now of this total risk, as you keep on adding more and more assets in your portfolio, the contribution of unsystematic risk starts to decline. Okay, and the only thing that remains in your portfolio is the systematic risk. Okay, so if we talk about the total risk, that is sigma, it has two parts. One is systematic risk, which is measured in the form of beta, and that is what capital asset pricing model gives us. It gives us a measure of systematic risk. And then we have the unsystematic risk, which is simply diversified away. If I have a well diversified portfolio, an asset portfolio comprising of many of the market assets. Now the efficient frontier, we have already read about it, so I will not dive into the details. So here you have the minimum variance portfolio, which is represented by point A. Any risk return combination below this are suboptimal, because for example, if I consider the point L, so it is for a level of risk which is at this point, but at the same risk I can earn a higher return if I go on the efficient frontier. So from the minimum variance portfolio, actually minimum variance portfolio marks the beginning of the efficient frontier. Okay, now next, here the example has been taken. If you consider K at the same level of risk sigma K, you are earning a return of ERK. If you select portfolio K, but if you go on the efficient frontier, you can see that at the same level of risk, I can earn a higher return, that is represented by point M, for example. Okay, so nobody would prefer this portfolio for investment, and that's why all the investments below this efficient frontier line are actually considered suboptimal portfolios, and on the efficient frontier line you have the optimal portfolios. On the beyond optimal portfolio efficient frontier line, you can't have any assets. We already know that. If you want to go beyond this level, then you will have to either add more assets in the portfolio, and if let's say you already have considered all the assets trading in the market, then one way possible is to include the risk-free asset and the market portfolio. Beyond that, it's not possible. Okay, we know based on modern portfolio theory. Okay, now let's talk about capital asset pricing model. What are the assumptions? First, it assumes that access to all market participants freely available, free information. Okay, second, no transaction costs. So basically you can say all the assumptions of modern portfolio theory apply to capital asset pricing model. Okay, allocation can be made. Yeah, one thing that is here important to note is that allocation can be made in investment of any partial amount. We are talking about perfect divisibility. So if you want to invest in 1.2 units of asset, that is possible theoretically as per capital asset pricing model. But in practice, we know it's not possible. I can either take position in 1 share or 2 share. It can be 1.2 or 1.3. Okay, so partial allocation is possible as per capital asset pricing model, but in practice, it's not. Then borrowing and lending rate is the same risk-free rate. Again, that's not true. Borrowing and lending rate are actually affected by the credit worthiness, and all other things are there. Okay, and also if there is a person who is into this borrowing and lending business, that's the bank. Okay, so they will not borrow it at the same rate. Okay, they will not do transaction at the same rate. If they are borrowing money, they will borrow at a lower rate, and if they're lending money, they will lend at a higher, and the difference will act as their income. Okay, but for capital asset pricing model, it is assumed the rates are same. Now, an individual investor's allocation decision cannot change the market prices. So if a single investor does anything in his or her own portfolio, then it cannot affect the market prices. Again, to an extent, I would say it applies to the actual market also, but not always. When the investors are huge and they trade in huge quantities, then it can have an effect on the market price. And also individual investors, all the individual investors doing the same thing at the same time can have a serious effect. In fact, that's why we have the day traders and all. Okay, so in reality, it not always hold true. Now, capital asset model shows the market equilibrium is achieved when all investors hold portfolios consisting of the riskless assets and the market portfolio. Okay, so the market equilibrium is achieved when an investor invests in the market portfolio in a portfolio, which is basically a combination of two things. First is the riskless asset or the risk-free asset, and second is the market portfolio. That gives you the capital market line or something like that. Okay, which is the final efficient frontier, the straight line that we have studied in VRM chapters, if you remember. Okay.
Now here you have the capital market line. This is your efficient frontier and this is your capital market line. It has a specific name. In the chapter we were discussing, I told you this also, that this line actually represents RFM. This line actually represents the final efficient frontier. Okay, which actually is a combination of, this line actually represents a combination, a portfolio, which is a combination of market portfolio, which is this, and a risk-free asset. And as you vary the weights of a risk-free asset and market portfolio, you can switch between these 2 points. If you want to go beyond M, you'll have to borrow at the risk-free rate and then invest everything you have and the borrowed money in the market portfolio. Okay. So here same thing has been explained. Okay. Now, let's talk about the capital market line. So the line that we are seeing here, okay, this line CML, the solid line. Okay. This line basically is given by this expression, which is RF plus RM minus RF, which is the market return minus the risk-free rate divided by the volatility of market times the volatility of the portfolio. Okay, this becomes the slope. Okay, this is basically the slope, and you can clearly see here, if you look at carefully, here the calculation has also been done, y2 minus y1 by x2 minus x1. That's the slope, and it is nothing but, if I consider these 2 points, the RF point and the point M, okay, then the slope becomes ERM, that is expected market return minus the risk-free rate divided by, what is this value on the x-axis? 0 to sigma M. So sigma M becomes my denominator. And that's what we have the slope here. Okay, this is the slope. RM minus RF by sigma M. This is the slope of capital market line. Now, next, CAPM beta. So if we talk about capital asset pricing model, we say that, okay, beta gives us a measure of the systematic risk, and capital asset pricing model helps us estimate the beta. So what is the formula of beta? Basically, beta is given by the relationship, which is sigma I by sigma M times rho I comma M, where sigma I is the return on asset, any asset or portfolio that you have considered. Sigma M is the not return, I would say volatility. Okay, volatility of the asset or portfolio under consideration. Sigma M is the volatility of the market portfolio, and rho IM is the correlation between the portfolio under consideration and the market portfolio. So in a way, you can say that CAPM is nothing but a regression result. Okay, regression of portfolio return on the market return. Now, usually in practice, what we do when we are implementing beta CAPM, we use proxies for market return. In the market, you have many assets. Like if I talk about the Indian stock market, there are more than 5,000 stocks. Okay. So what you will do, you will use index as a proxy. We usually use index as a proxy for the market return. Okay, however, it does not correctly reflect the fact that it's the market return, but yeah, it can be used. And usually bigger index like Nifty 500, S&P 500, BSE 500, these are the index that you will use, which consists of more companies. Okay, which are comprised of more companies. Okay, so this is what, and then you regress the portfolio under consideration, the returns on portfolio under consideration on the returns on market, you get the result for beta. Okay, and it's a systematic measure of risk. Now, if you regress the market return on the market return itself, like what is the systemic risk of market portfolio? Okay, then it will turn out to be 1. And it's natural to understand, because what is beta? Beta is the regression result of the portfolio under consideration and the market portfolio. Now, the portfolio under consideration is market portfolio itself. So you're regressing something on itself. So beta will be equal to 1 in that case. Okay. And that's why the beta of market portfolio is 1 by construction, because of the underlying statistics, mathematics. Now, beta estimation for beta for an asset is estimated by regressing returns, as I have already mentioned. There is no need. Okay. Least square regression line is plotted. Okay. And this is the formula. We have already seen it. The regression line is also called the security characteristic line, SCL. Okay. So what is the scenario here? You on x-axis, you have the market return. On y-axis, you have the portfolio return. And then you produce the regression line. That regression line is called the security characteristic line. Okay. And here the slope actually depends on the market portfolio, market portfolio return, and the beta of the, or you can say simply the beta. That is actually the slope of this line, security characteristic line. Okay. Here you see the slope has been shown. On x-axis, you have the excess market return. On y-axis, you have the excess asset return, and slope is being calculated. Now, usually what happens, you see, even if you don't consider the excess market return and just go for the market return, it will do the job. Because what is happening, theoretically, it is assumed that the risk-free rate is assumed to be constant. So if you add or subtract a constant number from both the variables, Okay, then it will have no effect on the regression. Okay, but if you go by the theory, then it is said that, okay, you should subtract the risk-free rate from both the market returns, daily market returns, and the portfolio return. Okay, portfolio under consideration return. Even if you don't do it, it will not have an effect. Okay, it will have a minor effect because it's a constant number that you are subtracting on both the sides. Okay, theoretically. But in practice, what happens? We know that risk-free rate themselves change over time. Okay, so if you want a more resilient, rather than just a rough beta estimation, you want a more strong estimation without less errors, then you will have to find the risk-free rate environment for daily. Okay, so if let's say you are regressing daily market return on daily asset return. Okay, so in that case, what you'll have to do, you'll have to collect data on daily risk-free rate. Okay, and that value is subtracted from both asset return and market return for that day. Okay, and new estimates are made where you have excess asset return, excess market return, and then you do the regression. Okay, that will be considered a more precise estimate, I would say. And what is the CAPM equation? It is simply given as ERI equals to RF plus beta I times ERM minus RF. Again, it can be rearranged. You see, if you look at it, just the regression line, then what you are regressing actually is excess asset return, that is RI minus RF. So the relationship should have looked like RI minus RF equals to beta times RM minus RF times the error term plus the error term. But here it is slightly different. Again, it's just a variation. RF is a constant. I can just transpose it to the right hand side of the equation and we will end up with this relationship. Okay, this is the CAPM equation. And it is used to find out the expected return on asset if I have the knowledge of the risk-free rate and the excess market return or risk premium. Okay, and the beta, of course. And this is what we call security market line. Okay. Now, idiosyncratic, if we talk about the most important takeaways from the CAPM. So first is CAPM equation for the expected return on an asset can be derived from the terms risk-free rate, beta, and excess market return over the risk-free rate. Okay, so basically, it's something that I have already said that if you want to estimate what is your expected return on an asset, you just need to know the beta, the market return, and the risk-free rate. You can calculate it. Then idiosyncratic risk. CAPM tells us that unsystematic or idiosyncratic risk can be removed by diversification, which is costless, and you are only left with systemic risk, which is the beta risk itself. Okay, then investors should only be, since diversification is costless, okay, there is no cost involved in diversification, you just need to add more assets. So investors should only be compensated for the systemic risk they are taking, the beta risk. Okay, and portfolios with same beta should have the same return. So if let's say you have created two portfolios, portfolio A and portfolio B. Okay, so if the beta of portfolio A is 1.2 and portfolio B is also 1.2, then their expected return on both the portfolios should be the same. If let's say it is 10%, then it should be 10% for both of them. If it is not, then this is what we call disequilibrium. Okay, so what will happen naturally? Arbitrage opportunities will exist. So let's say A is providing a lower return, B is providing a higher return. So people will start selling portfolio A and start buying portfolio B. So selling pressure on A, buying pressure on B. Prices will align themselves and come to an equilibrium where both of them will have the same expected return. Okay. Now, security market line, if the expected return is different than the expected return obtained from CAPM. So let's say you find that the expected return on portfolio A is 10% from historical data. Okay. And CAPM tells us that it should be, let's say 11%. Okay. So it means that the asset is not correctly priced and it will not lie on the SML line, security market line. So either it will lie above or it will lie below the security market line, the portfolio return. Okay. Now, asset having an expected return which is lower than CAPM is overvalued. Okay. So if an asset has a lower return, it means the asset is overvalued and it will lie below the SML. If an asset has higher return, it is undervalued. Okay. And it will lie above the SML. Now you might say that, okay, if the return is low and high, how we are able to say undervalued or overvalued? Look at it in a different way. I'll give you a different perspective here. So in the example that I took earlier, I said portfolio A had a return of 10% and portfolio B had a return of 12%. Okay. So naturally what would happen? People will start buying portfolio B and start selling portfolio A. Okay. So now this is in the percentage term. Now just transform it into monetary terms. When you sell something, when it is overvalued, when you buy something, when it is undervalued. Very simple. There is no need to dive into intricate mathematics where from return you are arriving at the value. Okay, just think it this way. Okay, portfolio A, portfolio B. A has lower return, let's say 10%. B has higher return, let's say 12%. Both have same beta. Okay. Now, the thing that I'm trying to say is that under these circumstances, naturally what will happen? We will sell portfolio A because it is providing lower return, and we will buy portfolio B because it is providing higher return. Now, just switch your perspective and think monetarily. Think in money terms, in dollar terms. When will you sell anything? When it is overvalued. Okay? When it is overvalued. That means an asset providing a lower return is overvalued. And when will you buy anything? When it is undervalued. That means an asset providing higher return is always undervalued. As simple as that. Okay. Now, here we have the characteristic of the measures that we've studied. So there are three measures that need to be considered. First is Sharpe, Trainer, Jensen. Okay, I'm not going into the formula, but from the examination perspective, I'm telling you formulas are important. So keep in mind the formula and especially the difference between Sharpe and Trainer. Okay, like what is the risk measure used? For calculating Sharpe, we use sigma. For calculating Trainer, we use beta. Okay, and what is the source? Portfolio theory. For Sharpe ratio, and for Trainer, it is the capital asset pricing model because it uses beta. And beta is a result of capital. Okay, criticized by role. Actually, it is not criticized, but Trainer has a lot of criticism. Sharpe is a better ratio when it comes to actual market scenarios. Okay, because it tells us the risk of the total portfolio. We can estimate the sigma of the total portfolio. But Trainer is something where you will have to estimate beta. So if you have a portfolio which is only a part, so the thing is, if you are investing in something in the market, you're not investing only in the equity. Okay, you are investing in bonds and other things also. But if it is Sharpe, it can be calculated for everything. But if it is Trainer, it can only be calculated for that part of your investment, which actually is made up of, I would say, equity, not the whole part. But Sharpe can be done for whole part. Okay, and that's why Sharpe, it is said that Sharpe is useful when portfolio constitutes individuals' total personal wealth, which includes equity and other investments. Okay, but Trainer is applicable only for a part of individual's personal wealth where that part constitutes only equity. Okay, only equity part can be considered. Then again, third is Jensen alpha. It is again risk use is beta. Okay, it gives us the source is CAPM, where we find out the excess return earned over the market return. Okay, and here ranking is done with the same ranking portfolios with the same beta. Let's say 2-3 portfolios are there, all have the same beta, which have excess return. Okay, the more the alpha, the better the performance had been. Okay, the better they have been able to perform. Next, you have the tracking error. So tracking error is basically volatility, or you can say volatility of the difference between the return on portfolio and the return on benchmark. So what it says is that, let's say you have portfolio return values, okay, in one column. In second column, you have the benchmark return, let's say S&P 500 index return. Okay. Then in the third column, what you will do, you will take the difference of asset return and the benchmark return in the order RP minus RB. So benchmark return is subtracted from asset returns. Okay. You take the difference, you square it, you find the variance of that difference. And then you take the square root of that variance. So that gives you the tracking error. So tracking error is basically the volatility of the difference between the portfolio and benchmark return. Okay. And it is also written as sigma EP, tracking error. Tracking error is used to assess success of the manager and should be kept below a specified level by the manager by reallocating portfolio regularly. Tracking error, basically, it helps you to identify if you have been able to maintain that thing or not. So usually what happens if, let's say, with time market dynamics change, return on portfolio will change. So your difference between the asset return and the benchmark return will start fluctuating. Now, if let's say you're promising that, okay, I want to keep my return 5% in excess of, let's say 5% in excess. I'm taking a very layman example. Okay, it's not a precise example, a layman example. So 5% in excess of the index return. So I need to ensure that my tracking error is somewhere around, I would say 4 to 5% only. Okay, so if it changes, I will reallocate my portfolio so that tracking error always stays at the given specified level, and I'm able to maintain that excess return that I'll be earning. And the better your tracking error is, you will say the better the manager has performed. And the poor your tracking error is, you will say that the poorly the manager has performed. Okay, next you have the information ratio, which is basically the return on portfolio, expected return on portfolio minus the expected return on benchmark divided by the tracking error. Or in other words, you can say this is alpha. Okay, ERP minus ERB is nothing but the alpha, excess return. Expected excess return, alpha divided by the tracking error. Okay, so this is the formula. Information ratio is used to assess if the manager's deviation from the benchmark has been rewarded with adequate return or not. Okay, it tells us how adequately this deviation has been rewarded. Okay, from the benchmark value. Next, we have the Sortino ratio. Sortino ratio is ERP minus the minimum acceptable return divided by the MSD mean, or mean squared deviation. Okay, now what is this Sortino ratio? So basically, sometimes what happens, we know that for assets, returns are skewed. Sometimes it can be skewed on the positive side, sometimes on the negative side. Sortino ratio tells us that, and then you have a target set. Like, okay, there is a fund which is a manager which is committing, which is saying that, okay, we'll give a return of 12%, 5% in excess of, or let's say our return will always be greater than 10%. Okay, it will be greater than 10%, not less than 10%. So your minimum acceptable return for this fund will be 10%. Now you would want to check, okay, has it been successful in doing so or not? So for that, you will find out what is your Sortino ratio, which is given as, first you will find the expected return on the portfolio under consideration. Then you will subtract it from the minimum acceptable return, which in this case was 10%. Sometimes minimum acceptable return will be the benchmark. Okay, can be the benchmark return. So in that case, MAR is replaced with the benchmark. But what is this MSD, mean squared deviation? Mean squared deviation basically talks about only one side deviation or downside deviation. Okay, so what you do, you only consider those scenarios to calculate the standard deviation, to calculate the volatility, where things are bad for you. That means negative returns. So you're only using negative returns to calculate mean squared deviation. Or in this case, what will be the negative deviation? That means only those returns which are below the MAR value, minimum acceptable return. These are used to calculate the mean squared deviation or standard deviation. So standard deviation you calculated using values, using returns below the MAR level is called mean standard deviation. So mean standard deviation has a formula also. So here you see RPT is less than MAR. It has to be this thing. And then RPT minus MAR whole squared. That's the formula, 1 over R. Okay. So this is how Sortino ratio is calculated, and Sortino ratio is useful when returns are not symmetric. Okay, symmetric means you know that, okay, return is skewed on one side, either on the positive side or on the negative side. So in that case, MSD is used to find out the performance of the portfolio. Okay, so with this, we have completed this chapter. Now just give me a few minutes. I'll start with the next chapter. Okay, so now we're going to start with chapter number 6, that is FRM 6, the arbitrage pricing theory and the multi-factor models of risk and return. So you see, the problem with capital asset pricing model was that it was realized very quickly after the model after the model was brought up, that single factor, there is that it is for sure that there is not only a single factor that can have an effect on the return on a portfolio. There are other factors, macroeconomic factors also, systemic factors also, that can have an effect. So how do we account for that? So for that, multi-factor models and arbitrage pricing theory was brought in. Okay, where it was assumed that there are more than one macroeconomic variables which can have an effect on the return on a portfolio. Okay, and how do we do it? So that is something that we'll study in this chapter. And later on, it was established that capital asset pricing model is actually a special case of multi-factor model, where we have, I would say, just one risk factor, which is the, I would say, just one risk factor, which is the excess market return. Okay. Now, later on, what happened? This capital asset pricing model was extended further. by Fama and French. It became 3-factor model. Then in 2016, it became a 5-factor model. Okay, so they were able to identify other factors as well. However, I would not say multi-factor means the Fama French factor models. Okay, it is one aspect of multi-factor models. There are other multi-factor models where not even excess market return, or I would say excess market return is considered, but other factors like value and growth factors are not considered. Okay, value and size factors are not considered. Okay, instead they use macroeconomic factors like inflation rate, unemployment rate, GDP growth rate can also be utilized to assess the expected return on a portfolio. Okay, so all these things come under the purview. So let's just start our discussion. Now, the capital asset pricing model was a single factor model, and it was a linear function of market risk premium over the risk rate. Okay, beta tell us how the excess market return was related with the excess asset return. Arbitrage pricing theory is based on the reasoning behind CAPM. Okay, what is the reason that CAPM actually exists? Okay, so arbitrage pricing theory is an attempt to explain why CAPM, why this happens, why it is able to explain the expected return on an asset. Okay, however, it explains an asset's expected rate of return as a linear function of several market factors. Okay, so instead of just one, APT assumes that there are several market factors that have an effect on the expected asset return. Okay, and what it suggests that there are multiple factors and that help explain the return on any risky asset, and these factors may include indices on stocks, bonds, commodities, as well as other macroeconomic factors like inflation, GDP, things like that. Okay, however, model does not specify which of these factors add to the explanatory power of the relationship. It just tells us that okay, these are the factors that can help explain the return, but whether they have an explanatory power, are they actually a factor responsible for a given portfolio, it does not tell us. So it is just like we'll have to do regression and find out which of these factors are actually relevant. Okay, and it was proposed by Steve Ross in 1976, and unlike CAPM, APT does not assume investors to hold efficient portfolios. That's the first deviation from CAPM. So even if you have inefficient portfolios, not a problem, you can hold it. Okay, so we now deviate from mean variance framework. Okay, and also they do not assume risk aversion. They are risk takers rather than risk aversion. Okay, so they will take risk. Instead, APT has three underlying assumptions. There are three assumptions. First one is asset returns can be explained by systemic factors. By using diversification, investors can eliminate a specific risk, firm-specific or idiosyncratic, whatever you want to call it, unsystematic. No arbitrage opportunities among well-diversified portfolios. If any arbitrage opportunities were to exist, investors would exploit them away. So if there are no arbitrage opportunities, and even if there are, it means they are short-lived. Okay, so let's say two portfolios with same beta have different returns. So immediately there will be arbitrage happening and the portfolio's value will reset, okay, to its fair value, so that there is no riskless profit opportunity. Okay, now the for any return on any security, the APT suggests that this is the relationship, okay, where ERI is the expected return on asset I, and beta I1 is the change in the value of RI if this factor change. And what is I1 minus EI1? It is the difference actually. Okay, is the difference between the observed value and the expected value. So what is happening? Let's say you know that the expected return on an asset is 5%. Okay, and then you identify that there are three macroeconomic factors that can explain the return on my asset. So for the time being, let's assume that the first macroeconomic factor is inflation rate. Okay, now some time ago you made an expectation, you made a prediction. Okay, you expected that the inflation after 3 months will be 4%. Okay, so that is EI. But after 3 months passed, you see that in reality the inflation is only 3.5%. So what will happen? You will adjust the return on your portfolio, on your asset, using this relationship. That is expected return that you already know plus beta 1 times I1, that is 3.5 minus EI1, that was 4%, and so on for other risk factors. And then you get the return on your asset on that specific, on that very day. Okay, or on that very time period. Okay. In other words, these numbers I1 minus EIK are also called the surprise factors, because this is what you were expecting, EI1, and you got this one. So what is the surprise here? So the difference between these two is a surprise factor. So that's why these EI1 I1 minus EI1 plus or IK minus EIK are called surprise factors in altogether. Okay. So here you see actual growth, GDP growth is I1, expected GDP growth is 3.6, that is EI1. This was expected, but in reality it happened 3.45. Recently also, if you talk about, everyone was expecting that, okay, India's growth rate, GDP growth rate will be 7%, but it turned out to be I don't know, 6% or something, but it turned out to be 8.5%. So expected was 6.5, actual is 8.5. So you need to adjust accordingly if GDP has an explanatory power for your asset return. So you'll have to establish that fact first, okay, before using this. Now, beta IK are the coefficients and EI is the noise factor. Nobody can precisely say that what will be the return. You can always make an estimation, okay, and there will be some noise at all times, okay. Now, APT was later on tested and it was found that the following set of macroeconomic variables have certain explanatory power, okay, for those stocks which are traded on NYSE, okay. First is the spread between long-term and short-term interest rates, the difference between short-term and long-term. Okay, short-term, you'll have to find like which is considered the short-term rate in the equity and long-term rate in the equity. Usually, I think it's 90-day T-bill rate is considered the short-term rate, and 5-year treasury bond rates are considered the long-term rates. So that's the difference that you need to take. Okay, then expected and unexpected inflation. Okay, inflation rate is the difference between the expected and unexpected inflation. Industrial production, there is an index on industrial production that you need to consider, that actually has been found to have an explanatory power on the return on stocks. Spread between high risk and low risk corporate bond yields. Okay, so there are corporate bonds which some have high risk and some have low risk. Of course, it has to reflect certain risk preference. So what is your risk preference? Which risk is considered high risk and what risk is considered low risk? So that's something that you'll have to define for that. So these are the factors that they found are relevant enough for NYSE. Now, out of these, I must tell you that maybe only 2 are found relevant for the stock that you are considering, or only 3, or in some cases, maybe all 4. Okay. So this is something that you'll have to identify using regression analysis. We have read it regression in detail, where we have saw how we build model and everything, how to identify relevant factors, what are the ways to do it. Everything is known to us, so we can use those processes, okay, those procedures to identify the relevant factors out of the given set of factors. Okay. Now, arbitrage pricing theory also gives us a premise that if investors can create zero portfolio with zero net investment, okay, if such a portfolio yields in a positive return, then there is a sure profit through arbitrage. And the fundamental result in the absence of arbitrage opportunity. So you see, the relationship that we saw here was in the presence of arbitrage. That means actual and real are different. Okay. But if, let's say, you assume that there are no arbitrage opportunities, then it can give you a way to calculate the expected return on the portfolio or on the asset. That is given as ERZ, which is your risk-free rate, times beta 1 times plus beta 1 times first risk factor minus the risk-free rate plus second risk factor minus the risk-free rate plus beta K times this final risk factor minus the risk-free rate, expected risk-free rate, ERZ, expected risk-free rate. Okay. So in the exam point of view, how you will understand it? So let's say they will give you that under no arbitrage circumstances, they will give you certain scenario that, okay, this was the expected values for the risk factors. This is the risk-free rate, expected risk-free rate. Now, if the realized values are this, and this, okay, so by what amount the expected return, the return on portfolio has changed. Okay, so what will be the new portfolio return in simple terms? So for that, what you need ERP. So you will calculate ERP using this formula, where you will use the expected values, that means no arbitrage opportunity, and estimate what is the expected return. Then you will incorporate arbitrage using the previous formula. Okay, this formula, where you take the difference between the expected and actual surprise factor, along with the expected return on the portfolio. That will give you the return on the portfolio today. What will be the return on the portfolio given these circumstances, I1, I2, I3 up to IK? Okay, given the actual circumstances. So that's how you apply these two formulas. And that's how these two formulas are different. This is the formula of APT when you have no arbitrage opportunities. That means the market is perfect in simple terms, I would say. Okay, CAPM scenario. And this is the formula when you are actually considering that the market is imperfect. There are arbitrage opportunities which are exploited again and again. Of course, they are exploited. Arbitrage opportunities are not lived long. Okay, they do not live for long. That's something that you need to remember. Now, if you see this thing, then you can say that, okay, my arbitrage pricing theory can give me the CAPM. So if I replace ERI with the ERM, expected market return, and I remove all the other factors, so what I'm left with is my capital asset pricing model. So arbitrage pricing model do lead us to CAPM, but it gives us more. CAPM does not account for imperfect market conditions. APT accounts for that. Okay, so that's an added benefit of APT. Now here the differences have been done. So I'll just ask you guys to just go through it. Like for example, CAPM is a special case. I've already explained these things. Okay, there are nothing extra that I have to tell in these slides. Next, multi-factor models of risk and return. One of the multi-factor model is French, is given by Fama and French. These were the two economists. They presented this in 1996, and it was a three-factor model which captures, which actually extends the capital asset pricing model, and they add two more factors. One is SMB, small minus big, that is the size factor. And then you have the HML, high minus low, that is the value factor. Okay, so size and value factor were added along with the market factor. Okay, now if you have to build a three-factor model, how you're going to do it? So first of all, there is an archive which is actively updated till date. Okay, by Fama and French. It is available on the internet. You can just search Fama and French archive. Okay, you will get the results. From there, you can get size and value factor. But if you will have to do it yourself, then it's a challenging, daunting task. There, what you will have to do, you will have to first identify small stocks, then large stocks. Okay, then you have to take the difference between the small stock returns and large stock returns. But the problem here is that if a stock is today small, maybe after some time it may not stay small. It will become big or medium size. Okay, so and then what is the criteria to define small and big? That has to be clearly delineated. Okay, and then only you will collect the data, you will take the difference, and that will become your size factor. Similarly, you have the HML. HML means those stocks, high means those stocks which have high book to market values, and those stocks which have low book to market values. So again, it's a challenge. You'll have to identify on a daily basis that which of the companies out of the 5,000 companies listed, let's say for example in India, so which of the companies have high book to market values, which of the companies have low book to market values, their return, daily return will be compared and difference will be taken. And this is not fixed again. Okay, the pool of high book to market value stocks will vary and the pool of low book to market value stocks will vary. Okay, sometimes a stock which was high book to market value earlier now become low book to market value. So you'll have to change the portfolio allocation on a daily basis. So that's the challenge. So if you're doing it one-on-one, like on an individual basis, it will be challenging. So the best thing is that there are official outlets there like Fama and Friends. They are doing it for free. It is available. You can download these factors and then just see how these asset returns or portfolio, let's say you have created, are related to the size factor and the value factor. Okay. And this is the extended form of the three-factor model. Okay, where you have the RF alpha P, which is the, of course, excess return. It should. Then you have the excess market return. Then you have the size factor. Then you have the value factor, high minus low. Okay. Next, factor hedging. So when you have idiosyncratic risk, that is a specific risk, I know that it can be very theoretically eliminated. But what about systemic factors? Systemic factors, we know that we cannot eliminate it. Okay, just by adding more assets. So for that, what you can do, you can go for factor hedging. So what you do, you identify a portfolio. You see that, okay, for your portfolio, certain factor beta is equal to this much. Then you look for the market portfolio. You identify what is the factor beta for market portfolio. And then you just go for beta hedging in that case. We have studied beta hedging in hedging using forwards and futures. Okay. Or hedging using futures contract. Okay. So that was FMP 8, I suppose. Okay. In this chapter, we have studied beta hedging. So here this beta will be factor beta. So when I hedge for a specific factor, then my exposure towards that factor reduces, gets eliminated. If I hedge for the complete, all the set of factors that I have exposure to, then what I end up earning is that I'll have the portfolio in my books, but what I end up earning is the risk-free rate of return, because everything is being now countered by the hedging position. Okay. Now here, as I said, if the goal is to hedge out all the factors, you create a zero beta portfolio and opposite is taken in each of the factors. Combined effect is you have no factor exposures, you end up earning the risk-free rate. Okay. If the goal is to leave portfolio exposed to certain types of systemic risk, then all factors are not neutralized. Only those factors which are relevant are actually neutralized. Okay. The selection of appropriate systemic factor depends in part on judgment, and there is no single perfect set of factors for all investors. Okay, it depends. Which are the perfect set of factors? Like what are the set of factors that I need to consider for factor hedging? So if you want to go for factor hedging, first you need to estimate factors. What are the factors, relevant factors? Then out of those factors, which you want to hedge. Now, there is no hard and fast rule for that. No single set of perfect factors. It varies from investor to investor. That for one investor, let's say inflation, GDP, market return can be one of the set of factors. For others, it can be industrial production, difference in the spread of the bond yields, and let's say market return can be another set of factors. So it can differ, and accordingly they can do the trades. Now, what are the challenges? First is the cost benefit trade-off. It is the continuous challenge. No matter how you do it, this challenge will stay there. Hedging strategy. If you are doing it on a continuous basis, then tracking errors will disappear, but it will lead to too frequent updation, thereby lead to higher cost, and overall performance will be reduced. So net benefit will get reduced because of the higher costs. Another challenge is model risk, because if you're modeling something, you are making certain assumptions. Factor model errors can lead to potential errors in implementation. So if you're going for factor hedge, you need to ensure that you are well covered for the model risk that can arise out of it. Okay. Finally, for example, here it is given, if let's say you build a trading strategy which is based on linear factor models. Okay, so they will fail to capture non-linear relationships among the factors and will be considered flawed. Okay, and we know that there are non-linear relationships. Then another common error in model building is to assume stationarity in the underlying asset distribution. We know that asset returns are not stationary over time. Okay, it's a proven fact. And that's why we studied stationary and non-stationary time series, and how we can transform a non-stationary time series to a stationary. Okay, they can evolve over time. Their volatility changes, their covariance, variance structure, correlation structure might change. Everything changes. So they are not stationary. Okay, and that's something that needs to be taken care of. Additionally, assumptions built into models may fail to hold in certain conditions, such as during stressed market conditions. So during 2007-9, a lot of market neutral hedge funds performed poorly because of their assumptions. Those assumptions were true in the normal market scenario, that okay, correlation structure is this and that. But during stressed market, we know that virtually correlation actually increases across the industries. Even uncorrelated industries start to show some kind of correlation in one way or another. Okay, so they start to perform poorly. So these things need to be considered properly before making a hedging decision. Okay, so with this, we have completed the chapter. Now I'll start with the next one. So just give me a minute. I'll open the slide. So now we are moving towards the next chapter, that is Principles of Effective Risk Data Aggregation and Risk Reporting, FRM 7. And let me tell you, it is a complete theory chapter. Okay, and if I present it in one way, then I would say that 1 or 2 questions you can expect from this chapter, and it's an easy grab actually. Okay, these are low fruits. You just need to understand the underlying logic. Okay, not everything need to be understood. There are a lot of examples and everything. So you just need to understand the logic, which all principles, what principle says what. Okay, what principle comes under what thing. Okay, which principle talks about governance, which principle talks about risk management, which principle talks about IT infrastructure, which all principle talks about, let's say, data aggregation. Okay, so everything you need to understand, and then just need to have a brief premise of what these things are. You will get easy marks in the actual examination. Okay, and these are no hard and fast science. These are rules and regulations designed by the BCBS, Banking Committee, Basel Committee for Banking Supervision. Okay, so it's just things to remember. There are 12-13 principles that we'll read. What principles explain what aspects of the governance. That's all. Okay, for risk data aggregation and risk reporting. So let's start. First, BCBS actually released 14 principles named BCBS 239. And 239 is just not 239. So 239, if you add them all, it's 14. Okay, 9, 3, 12 plus 2, 14. So 2 principles for one thing, 3 principles for something else, and 9 principles for something else. Okay, so that's how you can interpret it, 239. So it actually guides bank in enhancing their risk data management, emphasizing the critical importance of high quality data. Okay, how you can do it, how things can be done properly. So what are the principles? First is principle 1 for governance. Okay, they have defined principle 1 for governance. Principle 2 is for data infrastructure, data architecture, and IT infrastructure. Okay. Then principle 3 to 6 talk about strong risk data aggregation capability. Okay. So principle 2 about IT infrastructure and data architecture. That what is your IT infrastructure? What is your data architecture? How you are saving the data. Okay. Then 3 to 6 are for risk data aggregation capability. How you are aggregating, collecting the data. The collection process also should be very efficient, free from errors as much as possible. You can't have 100% error-free data, but as much as possible, you can have free from error. Okay. 3 to 6 define that. Then you have 7 to 11, which actually talks about effective risk reporting practices. That once you have aggregated the data, how you report the risk after that. What are the what should be the qualities of a effective risk reporting? Okay, of an effective risk report. Then principle 12 to 14 are basically about the role of supervisors. What roles do they have in this regard regarding data aggregation and reporting principles? Okay, so this is the basic premise of the chapter, that what principles talk about what things. Okay, now let's start. First, benefits of effective risk data aggregation and reporting. What is the benefit? So first benefit, again, you have enhanced data confidence. The data that you get, you are confident about it. That, okay, I can rely on it to do calculations. The chances of error will be minimum. Okay. Second, improved decision making, because you're basing on you are basing your decision on data which has been collected, aggregated, then worked upon very carefully. Okay, every step was effective in itself. So it will improve your decision-making process if you take decisions based on effective risk data aggregation and reporting capabilities. Okay, if your risk reporting was effective, then your decision-making will be effective naturally. Leveraging risk information. You have risk information, you can leverage that. You can use it to your own leverage, to benefit your own self, that you have more access to data now. You have collected things in such a way that you can look into finer details. Okay, identify loopholes and plan for that as well, which others might not be able to do. Then model validation. Since your data is good enough, you can validate your model quite easily on them. Transparency of business connections. You get to understand how transparent the business connections are. Okay, then comprehensive view of risk exposures. You get a comprehensive view because data have been collected very carefully in a very decisive way, following the principles and all. So when you look at the risk exposures using those data, which have been found using those data, that gives you a very comprehensive view, a very real view. Okay, not a biased or errored view. Okay, a very comprehensive, very detailed view, because you have done everything in detail. You knew what you had to do, and accordingly at each step when the data was being recorded, those things were ensured. Okay, that certain things will be in this column, certain things will be in that column. Just giving a very basic example. Okay, then you become stress resilient. Okay, because when the time of stress comes, since your data reporting capabilities are very good, aggregating capabilities are very good, so even in the time of stress, you are doing it in the most efficient way possible. So one stress, you record the data, you know very well what went wrong, what was right, what are the pros and cons, what was upside, what was downside. And for the next, you become more resilient. Okay. Then GC resolution, it has a benefit on that also. And enhanced efficiency and profitability. Of course, if you have such a huge solid foundation, then it will enhance your efficiency, right? It will enhance your profitability. You are now in a much better position to take a hedging decision, okay, or to keep a risk in its entirety, or to transfer it in its entirety. And when you are transferring, let's say you're buying an insurance, you are to a very high degree of confidence, you are sure that okay, this is the amount of exposure and I want to insure for this much amount. Okay, not more, not less. Okay, so that increases your efficiency and profitability at the end of the day. So let's talk about principle 1, that talks about the governance and what it actually includes. We'll consider that. First, it talks about the governance where we have to consider data integration. Okay, governance structure, the whole structure of the organization should be such that it should have the ability to integrate data necessary for Basel compliance. It can integrate it as and when required. Okay, then independent validation. It helps to ensure RDARR capabilities function, risk data aggregation and reporting, risk reporting capabilities, RDARR capabilities function as intended. Okay, so independent validation is a part of governance. Then policy forming, okay, is a part of governance. Should clearly define roles, incentive schemes, and responsibilities for the different stakeholders. Okay. Board oversight, review and approve RDARR and resource availability. Board in the governance, there should be board oversight. So everything is happening. Data integration, independent validation, then policies, then you have the board oversight. From bottom to top, we are getting. Okay. In board oversight, first thing is documentation, high standards of validation and independence. Then group structure, our RDARR should be unaffected by the bank's structure. No matter how the bank is organized, RDARR, risk data aggregation and risk reporting capabilities should be unaffected. It should keep on working parallelly, no matter what is happening, how the bank is organized. Okay. Then data quality risks. Identify, assess, and manage the data quality. What is the risk? Okay, data quality is bad. What is bad? Identify it, assess it. What is its impact? And then, if necessary, manage it, change it, modify it in some way or something like that. Okay. Then acquisition, evaluation of target firm and integration time. Okay. You see, the first thing that while acquiring, board oversight, board should do is that from the governance perspective, they should understand that what is the target firm's governance structure and what will be the time frame if I want to integrate both the companies in one. Okay, what should be the time frame? Because you see, there are a lot of things that need to be considered. The language, the internal language being used for different terms. Okay, the way they handle things can be different from the way things are handled in another organization. So everything has to be brought to a common ground. If this does not happen, then the acquisition or merger fails. And how do you say that it fails? Let's say a mass resignation. Okay, a lot of people feel like, okay, no, I am not understanding what the new culture, not the new governance structure is. I'll resign. Okay, so that's a problem. Then senior management oversight also comes under the board. And senior management actually supports RDARR with financial and human resources. Senior management is the one who will provide the financial resource to set up the infrastructure and all, and human resource who will do all these things. Okay, they support with RDARR limitations in coverage, technicality, and legality. Okay, like collection of certain data, is it legal or not? Senior management's duty is to do an assessment on it and bring it to the notice of board that, okay, this is something that is illegal or legal. We can do it this way. If some information is needed, what is the legal way to acquire that within the organization itself? Okay. And if I'm acquiring something, how can I use that information? That is also something that needs to be understood. Okay. So all these things can come under the governance. Who will tell whom what to do? Okay. Who comes under who, what to do? Everything is defined in the governance with regards to data aggregation and risk reporting. Okay. So this is the structure here. Now let's talk about DI and ITI, that is data architecture and IT infrastructure, that is talked about in principle 2. So it basically establishes integrated structures where everything will be integrated, and it has multiple parts. First part is data model. Model can be semantic, conceptual, logical, and physical. Okay. Then you have data categorization, consolidated categorization approaches. There are different types of approaches which can be used to categorize data, what type of data it is. Okay. And then based on that, you will use the data model. Then you have the uniform approach, same data models and assumptions. Okay, it does not have different data models. It has same data model and assumptions. Okay, and it is applied to all. Here, roles and responsibilities are defined, clear specification that who will do what, who will do when and how. Okay, everything is clearly defined. Data life cycles are understood clearly because a data relevant today may not be relevant tomorrow. So, for example, if I talk about how can I say, like from the perspective of educational institution. Okay, so if let's say there is an educational institution which is involved in providing education to 11 and 12 students. Okay, now that company needs data in order to make calling and like gain customers, acquire customers. Okay, so what they do, they collect data. Okay, they buy data from some data source. Okay, available, legal data source availability, available resources. So they buy it and they use it today. So today it is being said that, okay, this is the data of 11th and 12th student. Now, can I use this data, let's say after 1 year? Yeah, I can use it because it includes both 11th and 12th year data. So after 1 year, the students of class 11 will go to class 12. So yeah, I can use that. Some students of class 12 will still be preparing for that competitive exam. So yeah, I can use that. But after year 2, this data is of very little use. Okay, so as the time passes, the usability of the data is actually decreasing. In the first year, it was fully usable. All the data were relevant. After 1 year, I would say at least half or 30% of the data became irrelevant, 30 or 40% of the data. After 1 more year, almost 60 to 70% of the data becomes irrelevant. And after that, year after that, complete data set becomes irrelevant. So for how long you can keep on using these data sets? Okay, for that, you need to have adequate controls and you need to understand the data life cycles. Okay, then risk managers and IT specialists should be there whose responsibilities should be defined for data relevance, correctness, and integration. Okay, that how do they define it and how do they use it based on that. And everything comes under the planning process where RDARR is integrated into planning. Okay, all these things comes under the planning process. So this is the whole flow of the data architecture and IT infrastructure. Okay. Next, characteristics of a strong risk data and aggregation capability. So if you have a strong risk data aggregation capability, what are the characteristics? How will you identify that if there is a strong RDAC or not, risk data aggregation capability or not? Okay, first, you'll look for accuracy and integrity, which is principle 3. It states that you should be able to generate accurate and reliable data if this is being fulfilled. Automated generation, less human intervention, and the generation of data is mostly automated. Things are so streamlined, in other words. Okay. Ongoing monitoring, the monitoring of the data should be ongoing. The accuracy should be monitored and everything should be done properly. Next, you have the completeness. Second property of the risk data aggregation is completeness, which is talked in principle 4. Completeness means capture all material risk data. Okay, whatever is material risk that the company is facing should be captured. Okay, the structure should be such that. In fact, no company can ensure that, so every company works towards achieving these goals actually. Okay. Available by various groupings. You can have risk data available by various groups like business line level, risk level, product type level. You can make them available as and when required. Okay, so that less time is devoted on that. Okay, so that is what risk data aggregation means. Explain incompleteness to supervisor. If there is incompleteness in some aspects of the data generation or aggregation, okay, so you should be able to explain why this incompleteness. Okay, if it is explained reasonably, logically, then you are actually fulfilling completeness principle. Okay, then you have timeliness, generating timely risk data. Although let's say you have a structure which produce complete risk data set, but it takes a lot of time. Okay, let's say you want risk data by various groupings, but grouping structure takes a lot of time and you are not able to get data on time. That actually violates the timeliness principle. You should be able to generate data on time as and when required. Depends on risk nature, and it depends like what will be the timeliness. It depends on the nature of the risk, what type of risk you are assessing, because for different types of risk the timeliness varies. For example, for market risk, timeliness would mean, I think yeah, so timeliness would mean that you would require data on a daily basis. On other times, for credit risk, it can mean like in a year or so, something like that. For the operational risk, it can be different as well. Okay. Then considering risk area monitoring. What is the risk area you're monitoring? That also defines how timely you need the risk data. Okay. So there are certain risks which needs to be monitored on a regular basis, like liquidity, market. So there you need to understand what should be the timeliness. Then adaptability, principle 6. It says that on-demand reporting requests should be met. Okay, so if you have set a structure, it should not be rigid. If I say that, okay, no, I want data in this fashion, it can be presented in that. If I demand something in a specific way, it can be done. Okay, handle stress and crisis situation. The structure that I have set in to collect data, it is able to handle and collect and aggregate data even at the time of stress or crisis. Okay, that is something that needs to be ensured, and incorporate regulatory changes. If let's say for reporting and all, for aggregation and everything, previously there was some, initially there was some regulation. Let's say you can collect personal data. Okay, and let's say some of the personal data can be sold to other parties. So you were doing it accordingly. So you were aggregating it and you were grouping it in such a way that this group can be sold also and can be used internally, and this group cannot be sold. But later on, what happens? There is a regulatory reform and says that now nothing can be sold. So you need to adapt accordingly. Okay, the whole aggregation structure adapts accordingly to whatever the regulatory change happens there. Okay, or let's say regarding the calculation of risk capital, there are some regulatory reforms. So you need to adapt that accordingly. Just minor changes, and you are good to go. It's not like you'll have to complete rehaul, okay, the whole structure altogether. Now, next, effective risk reporting practices. Till now, we have talked about governance and all, risk data aggregation. Now we're talking about risk reporting. So risk reporting, accuracy. Reports should be accurate, which is talked about in principle 7. Okay, accurate and precise data. Reconciliation and validation. One should be able to reconcile that okay, this is also saying this, and yeah, here also I'm getting the same thing in the risk report. And one should be able to validate reconciliation and validation. That's why. Critical decision support. This report should be such that it helps us to make certain decision. It's not like, okay, just the data has been presented, now what to do. Okay, based on that, I can make certain decision. It should be so clear, so accurate. Then you have comprehensiveness. It should be comprehensive. It should cover almost every aspect that is needed. Cover all material risk areas. Size and complexity alignment, include all risk types. Okay, then clarity and usefulness. There should be clarity, no ambiguity, and it should be useful. That is being talked about in principle 9, where clear and concise communication should be there. No dilly and dallying, no talking about may happen, that happen. You have to be very precise about what is happening. Okay, tailored information and balanced content, not over content. Do not write something in excess also, or something in uh, something too much less also. Okay, you have to create a balance there. Then frequency, principle 10. Frequency, recipient needs and risk nature. So how frequently you can produce it. So if risk reporting is there, sometimes there are periodic risk reports, but sometimes there are ad hoc risk reports. Sometimes there are on-demand risk reports. So you should be able to meet that frequency with which it's being asked. Okay. Speed of risk changes, how quickly the risk is changing, and accordingly how quickly you are able to produce those reports. Okay, stress and crisis consolidation. These things should be considered. Then finally, distribution, which is principle 11. That means it should be distributed to all the relevant parties. No one should be missed. Okay, confidentiality should be maintained at all times, because it's a risk report. It's a very confidential information. It tells everything about what are the loopholes for the company, and if in the wrong hands, it can bring disasters on the company. Okay, then there should be a proper distribution lists, that who are the people with whom this risk reports can be shared. Okay. Next, the role of supervisor, the final thing. Okay, so bank supervisor's role, first, review, which is talked about in principle 12. Here, the supervisors need to conduct periodic compliance review. They need to access reports. They need to have access to the reports all the time, whenever needed. Testing in normal and stress scenarios. They need to test their infrastructure in normal as well as in stress scenarios, and in cross bank reviews. Okay. Then remedial actions and supervisory measure. It is being talked about in principle 14. Some remedial actions can be taken if some fault is found. So tools and resources should be there. Addressing deficiencies, that is the role of supervisors. Setting limits, implementation of plans, monitoring effectiveness. Everything comes under the purview of supervisors. Okay, so that's what supervisors do. Now let's talk about the final thing, that is home host coordination. Okay, it is also covered under the principle 40. Okay, what is home host coordination? Cooperation with other supervisors. Okay, sharing information with other supervisors, like your equals. If you are director of one department, then somebody is director of other department, your equals, or maybe supervisors of other department who may be your junior or senior. There should be proper coordination. Okay, proper sharing of information. Communication should be proper, sharing experience should be proper. Okay, so these are the things of risk data aggregation and reporting capabilities. So with this, we have concluded this chapter. Now we are left with only one chapter, that is FRM 10, the anatomy of the global financial crisis, the great financial crisis. So just give me a minute. I'll just share that. Okay, slide. Okay, so now let's talk about the anatomy of the great financial crisis. This is the final chapter of our discussion today. And in this chapter, we will see the important highlights of the great financial crisis from the risk management perspective that could be understood at this level, at the level of FRM part 1. Okay. In fact, in part 2 also, you will see time and again references of the great financial crisis in multiple chapters, be it credit risk, market risk, liquidity risk. Okay, even in operational risk, you will find the references. But here we are talking about overall what happened, the basic premise of financial crisis, and what went wrong, what went right, what were the causes and everything. Okay, so without wasting any time, let's start. First, let's have the background of subprime mortgage. Okay, so in United States, consumer credit quality is measured using FICO score. In India, we have CIBIL, Experian, Equifax, things like that. Okay, in US, you have FICO score. Okay, FICO score takes into multiple factors under consideration, and similar is true for credit score, consumer credit score in any country. First is credit history, outstanding debt, payment history. Okay, for how long you have been taking credit? What is your credit history? Like, first loan, when did you took? Like, was it 7 years ago or 8 years ago? What was your payment history? How frequent you have taken loan, and how you have repaid it? Have you repaid it on time? Was there any problems? And what is your current outstanding debt? These are the things that is considered. Okay. Now, borrowers with limited credit history or high outstanding debt or delinquent payment history, that means they have been defaulting on their payment obligations, they are categorized as subprime borrowers, and it is true for every country. Okay, subprime borrowers means either you don't have sufficient credit history, or you have very high outstanding debt, or you have delinquent payment history. That means in the past, while making payments, you have defaulted on your payment obligations. So you didn't pay on your due date. Maybe after some time, after adding some charges and all, you were able to pay. So all these things, if either one of them, or even if all, okay, let's say some or all, okay, are the characteristics in somebody's credit score, then that person is considered a subprime borrower. Okay, and the residential home loans to such borrowers are called subprime mortgages. Residential home loans given to subprime borrowers with either or few or all of these characteristics. What characteristics? Poor credit history, high outstanding debt, and delinquent payment history. Okay, or irregular payment history. Mortgage loans given to these people, home loans given to these people are considered subprime mortgages. Okay, now subprime mortgages actually became very popular in the US prior to the in the prior years of financial crisis, and there was a reason for it. Okay, like the American dream kind of thing was happening. Interest rates were way too low. We'll see everything in detail. Okay, so what actually caused it? In 2007, if you see the subprime mortgage debt, it was at around 1.3 trillion US dollars. Okay, the subprime. That means this much loan was given to those people who had some issues with their credit worthiness. Okay, who had some issues, and we know that for subprime mortgage debt, the I would say the default rate is very high. The probability of default is very high. And in these cases, if I talk about the loss given default, given the circumstances, what was prevalent in the I would say during the 2007 and 9 crisis, I could roughly say that out of this 1.3 trillion dollars, around 300 to 400 billion dollars was at risk, and this is not a small amount. 300 billion dollars, it's huge. Okay, it's way too huge. So, and that is only for the subprime mortgage. Okay, and when things start to go bad, even prime borrowers will default. Things will spiral down in something which is just out of control, and that is something which happened in the 2007 and 9 crisis. And one of the biggest culprit was the subprime mortgage. Okay, subprime mortgage, I'm not saying that one should not give loan to subprime borrowers. Okay, it should be given, but of course after assessment, and the percentage of loan given out as subprime should be comparatively less than the prime borrowers. Okay, now let's see how crisis found its roots, like what happened before the crisis, prior to the crisis, what was happening in the US market, because then it will help you appreciate what happened during the crisis, how things unfolded. Okay, so first, if I talk about the global financial crisis, it was global scale. Many countries were affected. Its after effect was seen years after the crisis was over. Till 2010-11, its heat was felt. After effects were felt. Large losses were happening. Bank failures were happening. Okay, some bank failures are like Northern Rock, Bear Stearns, Lehman Brothers, things like that happened. Liquidity was frozen. Nobody was able to, at least in the short-term lending market, money market. Okay, liquidity was completely vaporized. There was no liquidity. Nobody was able to roll over their commercial paper, thereby leading to problems. Okay, ABCP market and repo market. Repo market was to an extent functioning, but with large haircuts. Okay, because repo, we have high quality credit instruments, government securities are there. ABCP, it is asset-backed commercial papers. Okay, and the asset that were used to back these commercial papers were mostly comprised of subprime mortgage securities, and nobody knew what amount of this mortgage security is comprised of subprime mortgages. Okay, so everybody was like, okay, we don't want to do it. We don't want to do it. So in ABCP, it was complete freeze. Okay, no transaction was happening for quite some time. In repo market, transactions were happening, but at a very huge haircut. That means the discount was huge. Then a lot of SIV failures happened. Okay, now downturn in the subprime mortgage market. Okay, it all started with the downturn, great financial crisis. Okay, first was what led to the downturn. So downturn was because of massive credit growth in the years preceding that. Interest rate was all-time low during the early 2000s. Okay, housing were made at an indiscriminate rate. I would not say abnormal, indiscriminate. There is no restriction. Houses were increasing at an exponential rate. Okay, housing price bubble. So everybody was like, okay, house demand is increasing, and people are buying houses, And what happened in fact is that a bubble was created. It was a hype. And one day or another, this continuous increase in the price of houses was going to stagnate, market would consolidate itself, and then there will be a decline. It will reset to its fair value. Everybody knows it. There is a reset, always. Okay, no matter how high the stock goes, it will reset itself. There will be consolidation in the market. And when the things reset, that's what we call the burst of the bubble. Okay, so things were expanding, and then it went all hell break loose. Okay, so that kind of things happening. Then financial innovations were happening. CDOs were introduced, securitization, CLO squared. Okay, TRS. A lot of innovations came into the picture that helped reduce the securitization in itself was a financial innovation that helped reduce the credit risk for the banks. Okay, excessive leverage. Okay, leverage was huge. So leverage means if let's say you are taking 1 unit of risk, so how much capital you have backing it. So at the time of bankruptcy, I'll just give you an example. The leverage of Lehman Brothers was 31:1. So they had borrowed 31 rupees and they had just 1 rupee capital. So that's the leverage, excessive leverage. Now, when the things are good, it's really good. You can benefit out of it. Excess return will be there. But if things go sideways, okay, then you are gone forever. And that happened with Lehman Brothers. Okay. Now let's talk about other things. So apart from massive loss of wealth and high unemployment around the globe, the peak that is during September 2008, a lot of things actually happened. There was a cascade of events. First was bankruptcy of Lehman Brothers. Then Morgan Stanley and Goldman Sachs were converted into bank holding companies, BHCs. Okay. Then Fannie Mae and Freddie Mac were nationalized. AIG was brought back from the brink of collapse via $150 billion capital infusion, because literally AIG had ensured the complete financial industry, or in a way I can say complete US economy. So at that point of time, US economy was going bad. So everybody was going to come to AIG, now give me my money. So how were they going to do it? So for that, $150 billion of capital was infused in just one single organization, that is AIG. Next, in Europe, what happened? Dutch financial conglomerate was there, Fortis. It was broken up and sold. Entire Icelandic banking system collapsed. It did not happen exactly at that point of time. After some time it happened, but yeah, it collapsed. Okay. And there were subsequent debt crisis during 2010 in the Europe, which was an after effect of GFC only. Like Greece and other countries, they defaulted, right? If you remember clearly. So this was an after effect of GFC. Now, how it all started. First, low interest rates in the early 2000s. That was the biggest cause. So low interest rate means now loans can be given out at a lower interest rate. Okay. Housing price increased. Housing demand increased. Okay. And at the same time, mortgage financing increased. People were asking for homes. Low interest rate. Mortgage financing also increased. People were to buy houses. Okay. So these were going in unison. Then at the same time, within the mortgage financing, subprime mortgage also increased, because you see, there is a limit to prime borrowers. Okay. In order to become a prime borrower, it takes time. For example, if let's say I was new to this industry, let's say I didn't have any credit history as of now. Let's say I don't have any credit history, for example. If I go to get a credit card, is it possible to me to get a credit card? No. because I am a subprime borrower right now. Why? I don't have a credit history. Or maybe let's say I am delinquent of some payments in the past. Then also it will be difficult for me to get a new credit card or a new loan. Okay. Or I have a very high debt outstanding. Then also credit card companies will never give you a debt. Okay, a credit card. But for example, let's say I'm a prime borrower. I started with somehow smaller loans and things like that. And then I build my credit profile. And finally now I have everything in place. Okay, I have a good, decent credit history. I have decent mix of loans, secured, unsecured, everything. I have, let's say, not too high outstanding debt. I have made all the payments on time. Now what happens? Now you have become a prime borrower. Now banks will call you that, okay, you take my credit card. I'll give you this much unit. I'll give you this feature, that, so and so. Okay. But for some prime, subprime, it does not happen. Now during that time, what happened? So people like us are actually limited. Okay. Who are prime in nature when it comes to borrowing. Okay. So, and if there is a demand to create more loans, so naturally what will happen? They will switch to riskier side. That, okay, let's take on board subprime borrowers. Okay, let's give them loan. Let's give loan to them too. Okay, we'll charge a higher interest rate. That's all. And in any ways, OTD model was there. Nothing was to be kept in their own books. So they were a little bit delinquent on that aspect. Okay, they didn't did proper due diligence, which should have been done actually. Okay. Then what are subprime mortgages? There are multiple versions. ARMs, adjustable rate mortgages were there, in which for some period your rate was very low, and after that the rates would reset to the market rate, and you would your EMIs would increase. Okay. Then in another version of ARM, for this initial period you were only required to pay the interest. Okay. Principal and interest payments would start after 4 or 5 years or something like that. Then you had piggy loans. Piggy loans were you see, whenever a loan is given by a company or a bank, they ask for mortgage, right? Or some kind of collateral or a down payment, I would say. Okay. So usually what happens if, let's say, you're buying a house, so they would say that, okay, 30% of the money you'll have to down pay. Okay. You will have to pay, and rest 70% will finance. Okay. So these banks, what they started to do is that if I am a subprime mortgager, okay, I am a subprime borrower. So I want to take a loan. I don't have collateral money also. I don't have the down payment money. What these people were doing, they were giving a piggy loan, a side loan, okay, a personal loan kind of thing, which the borrowers can then use to make the advance, the down payment for the mortgage loan. So think about the cushion. There is no cushion at all. These advance payments, mortgage, collateral, whatever are these things, these are meant as cushions. Now here, by giving you loans, you are reducing your cushions itself. Nobody was talking about it. Okay, then you had liar loans where you could easily lie on the loan agreements, and it was given no due diligence, no verification, scrutiny, nothing. Then you had ninja loans, no income, no job, no asset. You have nothing, you are getting loans. You're a homeless guy living beside the road. Okay, and you have a house. Ninja loans were given. Why? Because for a certain period, the interest payments were way too low. Now, because of these two things, so these were the subprime mortgage that we saw in the sideline. Now let's get back to housing demand and mortgage financing. In the mortgage financing, we saw what was the issue. Okay, so this is the issue building. Okay, this issue is building continuously. But parallelly, what is happening, and nobody is looking at this side. Parallelly, what is happening? Housing demand is increasing and mortgage financing is increasing. So this led to a huge pressure on the housing prices. Prices start to increase. And also it led to securitization. Since more mortgage financing was happening, more securitization was being done. And more, what was coming into the securitization process? More and more subprime mortgages were entering into the securitization process. Okay, that's the problem. So securitization, pool of subprime mortgage, model-driven cash flow bifurcation, repackaged into investment grade securities and CDOs. Okay, they were repackaged, investment grade. So subprime mortgage becoming an investment grade, triple A rated security. Somehow it was happening through the securitization process. Then through securitization, alternative investment, basically these are the things: CDOs, CLOs, asset-backed securities, everything. Okay. And because of this, a bubble was built. Housing price was increasing. And one more thing that happened here was that a lot of people started to speculate. Now, since housing prices were increasing, what people started to do, they would buy a house today. After 2 years, they would sell it at profits. Those speculators also increased the housing prices, okay, to a new level. Some genuine borrowers were there, but others were simply speculating on the rising home price. For both, loan could typically be refinanced once the teaser rate period ended, ARM. Okay, adjustable rate. So you see, it was a thing like, okay, today you take a loan for 30 years. For 5 years, you will pay teaser rate. That's a lower rate, 3 or 4%. But from 5 year onwards, from fifth year to the 30th year, you will pay a higher rate of interest, let's say 6% or something like that. That is what we call reset period. Okay, teaser rate period, end of teaser rate period. So the idea was the moment the teaser rate period would end, I would refinance it again. And then for the next 5 years, again, I will pay the teaser rate only. I would refinance it again, I'll pay the teaser rate only, and my loan will be paid off. Okay, now the problem with this was that this will work if and only if refinancing was possible. If refinancing was not possible, then what the speculators would do, genuine borrowers face problem, but speculators, they would default. Okay, I'll default, go sell the house. Okay, so that was the idea, whole idea. And that led to even more defaults. Speculators defaulted a lot. Then the misuse of OTT model. OTT model was pretty simple. Lending increased without lending limit violations, because nothing was on the bank book. Okay, everything was being transferred in the form of securities. Reduced due diligence. Okay, it was not the problem of OTT model. It was the people who used this model that created a bad name for OTT, originate to distribute. It's not a bad model. Okay, so they did not do any due diligence. They were not checking the applications properly. Whoever was coming, give it loan, give them. You also take it. You also take it. You have one loan, you take 2 more loans. These kind of things were happening. Okay, due diligence was reduced completely. Then subprime losses. What was happening? It was simply being transferred because nothing was on their banking book. Everything was going into the process of securitization machine. Okay, securitize it and sell it to the investors. Now, delinquencies on ARM, adjustable rate subprime mortgages, approach 16%. So you see, just imagine 16% of people defaulting on their loan obligations. How bad it is by August 2007. By May 2007, it was 25%. So by we saw that it was $1.3 trillion. So just imagine 25% of that amount, 1.3 trillion. It's more than $300 billion. So I was roughly right by saying that, okay, this was the scenario. Okay, now what caused the increased delinquencies? In fact, the delinquencies or late payments were increasing after right from mid 2005 only. But as I said, it's like a moonwalking bear problem. Okay, so you might have read these things in and where it says that, okay, you're busy in something so much that you don't look other things that happened right beside you. Okay, the moonwalking bear. Okay, so it was happening right from the mid 2005. Nobody took a notice of it. Okay, what was the reason? Poor credit quality and under collateralization. Piggy loans were there. Subprime borrowers were there. Zero down payments, even for the first time borrowers, again through piggy loans. Okay, ARMs with teaser rates or interest only features for 2 to 3 years. So the problem was after 2 to 3 years, the rates will reset. Okay, to actual rates, and then you will have to pay a higher EMIs. And now these ninja loan owners or liar loan owners or subprime borrowers, are they in a position to pay out such huge amount? It was just the expectation that in the next 2-3 years my financial situation will improve, or let's say I'll be able to refinance the loan once again at the teaser rate, interest only rate. So these things were the reason that these were not possible, that refinancing was not possible. People started to default. Beneficial if rates declined, but the rates actually rose. Now after 2005, during 2005, what happened? It was beneficial. So when will you refinance a loan? You will refinance a loan when the interest rate environment has declined. We have studied it in mortgage-backed securities chapter, right? But from 2004 onwards, what happened? The interest rate actually started to increase. So if you are going to refinance, you will end up paying a higher interest rate, even higher than what you are paying right now. So would you refinance? Refinancing is not possible in this case. So delinquencies increased. Then decline in refinancing abilities. Of course, all these are related. Housing price bubble burst and the value of collateral declined, leading to more defaults. Now you see, one might say that, okay, what about the other borrowers who were actually there for home? Okay, so they felt like, okay, housing price bubble burst. So they took a loan at a very high rate. Let's say $1 million they paid for a house. Now that house is priced at $200,000. But the loan was on $1 million, which is now valued at $200,000. It is not worth that they will pay so much amount for this something which is only $200,000 worth. So they defaulted willingly. Willful default started to happen. That, okay, I won't pay. You sell the house, take your money. Okay, why? Because this house is not even worth 200,000, not even worth 25% of what I have taken the loan for it. Okay, today that was the final nail in the coffin. Housing price bubble burst. Okay, now finally, questionable lending practices, nobody can doubt it. Okay, there were lending practices which were completely questionable. What were these? Increased lending to non-qualified borrowers like ninja loans, liar loans, then selling subprime mortgages even to better borrowers. So let's say I had a good credit history, but just because in subprime, what would happen? It would ensure the banks, or let's say in the securitization process, that interest rate will be high. So even though I qualify for a prime mortgage, I was diverted towards subprime. Now just think about how will I feel in this case if I have been diverted to subprime. I would want, if everything goes bad, I would want to default in that obligation, right? So that happened. Then faulty compensation structures for mortgage brokers. The compensation structure was faulty. They just wanted on the quantity of mortgages, not the quality of mortgages. Okay, so that was the problem. False documentation was there, fraud was there, everything was happening. Now let's talk about the role of financial intermediaries. So intermediaries like SIVs, okay, they acted as conduits. Okay, like, okay, you give me, I'll do it on your behalf. Okay, so they would transfer it on their own, and they were bankruptcy remote companies. They would purchase asset, fund it using short-term commercial paper that they issued. Okay, and that's why these short-term commercial papers were necessary. Okay, in order to keep on rolling it over. Okay, because they use it, they bought long-term assets which will provide all the money not in one go but over extended periods. So they need the capital all the time, right? So if they have borrowed initially, let's say today, they wanted to buy a portfolio of loan, it was worth 1 million. So they went into the market. They said that, okay, this is the portfolio. I'll create this out of it. Okay, like kind of pitching, startup pitching. I'll create this out of this portfolio. These kind of securities, very, very safe, this and that. And I myself am a safe, very, very safe institution. Okay, you see my other securities, they are very high rated. I'll not default. So investors gain confidence. They say, okay, this is the pool of, or the mortgage portfolio on which you are asking me a loan. Okay, I'll give you 3 months, this rate, you take it. Okay, now 3 months I bought it using that money, and then I securitized, I sold it in the market. Okay, now once I sold it, I'll be receiving certain commission, right? So and the people will be receiving these things. So what happens now? I have to roll over these commercial papers time over time, because these are not sold in one day. Sometimes sold because I have to be there buying and selling continuous. Okay, so now I need, after 3 months, I have to close out existing commercial papers that have been issued. So what I do, I go into the market, I issue new papers on the same. Okay, you see, this is a security that I'm backing, give me this money. Okay, they take it and pay out existing loan. And this is what we call rollover, and it kept on happening. Now this structure will work if and only if the commercial paper market has confidence in what the SIVs are doing. Okay, in what the SIVs were doing. If they lose confidence, SIVs won't be able to roll over their loans that they have taken, the commercial paper, roll over their commercial paper, thereby they will be defaulting, direct default. Okay, and ultimately what would happen? The parent companies would have to intervene in that case. Okay, so during securitization, what they did, tranches were structured such that most of them got government investment grade ratings. They were structuring things in such a way that, okay, we'll do this, we'll do that, this is the capital, this is how the payments will be made, everything, waterfall, all things that were designed in such a way that almost all the investment securities created were investment grade rating, got investment grade ratings. The most senior debt was senior AAA debt, which was considered super senior. Then you had senior tranches like AA rating, where with the security swap was also sometimes used. Security swap, I have already, ROP. Security wrap, I have already explained what it is. Okay. Then over the period from 2003 to 2007, banks appear to have used securitization to keep their credit exposure. Okay, to AAA tranches. Okay, why? What happened now? Once the securitization happened, the idea was, you see, where was the problem? It would still, nothing would have happened even after the housing prices bubble burst. Okay, the idea was that once the securities are created, we will sell it to the investors. It will get distributed among large people, broader base. Thereby, I'll have a huge shock absorber if anything bad happens, even if there is a housing price bust. Okay, but here banks became the real culprit. So one bad thing, what they did, they issued bad loans, and now those loans were converted into securities, and those securities got higher AAA rated credit ratings. And these banks again bought these securities back, brought it back onto their balance sheet. Why? Because they were providing extra yield. Okay, and they required, because since these were rated AAA, so they required less credit capital requirement. They required less capital requirement under Basel II. They found a loophole. Instead of holding loans, if I hold these securities, I'll have to keep in reserve lesser number of credit capital, and I'll keep on earning good returns. Okay, higher than average returns. So instead of distributing these risks across the wider group of investors, it got concentrated back again into the banks. Okay, big banks. That was the second issue that happened. Okay. So here it has given, like for residential mortgage, the risk weighted RWA is 50%, and for AAA tranche it is only 20%. So 30% less capital requirement. That's huge money. Okay. Now, what was the issue with rating agencies? CDO trust partners were there. They paid rating agencies. Okay. Thoroughly understood the requirements of top ratings. They knew what rating agencies would look for if they are providing a rating, and they just covered those loopholes. They made flawed assumptions, not reflecting the current changes in asset properties. Okay, they were talking about historical, and rating agencies also did not take their own initiative to look into the loopholes or to do a thorough investigation of the models that were being used for valuation. Okay, so relied on data from issuers and arrangers. They didn't do anything for themselves. Okay, you are saying I believe it. That was the thing that was happening. Okay, ignored the declining lending standards and internal fraud. Continuously news were coming up that lending standards is not good. Loans are being given to a lot of people who are not credit worthy. Internal frauds were happening, but still rating agencies were not at all worried. Okay. Then they ignored analytical flaws in the model. There were analytical flaws. Certain assumptions were made which were not correct. Gaussian copula was used, which is a normal distribution assumption. And we know that it was the biggest fault. However, it's not a mistake of Gaussian copula. The problem is the person who used Gaussian copula. Okay, Gaussian copula was not meant for these models. Why were you using it? The problem was that. Okay. Then continuous incentives were strong for providing ratings. Okay, so there were continuous incentives to feel like, okay, why should I do? I'm getting the incentive. I'm getting the money to rate. Okay, so let's keep on rating it. Let's believe them. That's what the thing. Now let's see the short-term wholesale debt market. As I said, SIV in the previous slide, when we were talking about SIVs, I mentioned that what happened there. In the SIV scenario, the scenario was SIVs would go to short-term wholesale market. They would issue commercial paper and they would just keep on rolling it over. Okay, so what was the problem? First, let's understand the wholesale debt market. There was a repurchase agreement, repos, and then you have commercial papers. Repos were pretty much doing in some way or another, but repos also faced some issues. Commercial paper, it was given a full blow. Okay, that means knockout, complete knockout for commercial papers. Okay, used by banks, brokerage firms, and money market funds, sorry, not frauds. Then involves selling an asset and entering an agreement to buy it back at a later time. We know what repurchase agreements are. They're excluded from the bankruptcy process. They are not included in the bankruptcy. Involves haircut for assets with high quality assets having lower haircuts. Okay. So there is haircut. That means you sell it at a lower price and then buy it at a higher price. So the difference is called the haircut. And usually, if high quality assets are used, the haircuts are very low. Okay. In the case of commercial paper, these are short term. No specific collateral is there. Okay. Unsecured commercial papers, issuers have very high credit ratings, like the SIVs. ABCP is a type of CP where purchased assets served as the collateral. So the asset which will be purchased using this money is served as a collateral. So the mortgage portfolio purchased from the bank in this case. Okay. The assets were mostly the securitized AAA tranche. The assets, they were mostly securitized into AAA tranche. So that means they were giving a sense of relief to the investors that, okay, I have a backing from a AAA rated security. So the chance that I lose my money by investing in ABCP is way too less. Okay. Now the liquidity crunch hits. It started from there only. The short-term funding, SIV funding, rolling over short-term debt to finance longer-term and longer-dated assets, AAA tranches. Problem was the assets were MBS, which included huge amount of subprime mortgages. Okay. Then ABCP loses value and SIVs fail to roll over the debt. It was a lot of subprime mortgages. So naturally, what would happen? The delinquencies when became an open and shut case that everybody knows, okay, there are delinquencies. The housing prices bubble has burst. The housing prices are falling. So what happened? The investors in ABCP, they lost confidence in these securities, commercial papers. Okay, why? Because a lot of them was subprime mortgage, and there was no clear way to identify, like, okay, how much was going to be the loss. Nobody was aware of it. Not even the banks who issued it. Not even the SIPs who created the securities. They were also not knowing what will happen. Okay, what will be the loss. So ABCP lost value, and MBS loses value and credit quality declines. The SIV's credit quality started to decline. More and more haircuts. OIS, overnight index swap rates, swap spreads started to increase. Okay. Before crisis, OIS and swap rates were not considered any different, but now there was a clear difference. OIS shot up. Okay. Overnight index rate, overnight index swap rate shot up very high. Okay. It exploded. Okay. So here you can see the percentage also. In percentage terms, it is. So before the crisis, you see it's somewhere it is 0.5. I think in not even 10 basis point. The difference is only 5 basis point or something. But at its peak, what happens? You see from here onwards, 1%, and it go as high as 3.7%. The difference between OIS and swap rates. Okay, OIS rates and swap rates. So what happened? Credit spread went up. Credit assets lost value. Haircuts increased. And you see the extent of haircut at the peak. By the time this was actually in its peak by like in the early months of 2009, haircut was as high as 45%, right from almost 0%. The haircut went out to as high as 45%. Okay. Simultaneous asset sell-off. People started, nobody wanted to keep this in their books, because these securities, nobody know what the risk is, how much I'll lose, what the loss in the value will be. They started sell off immediately, everybody. Okay. Asset value falls deeper. Equity wiped out. Okay. End of the story. So nobody is buying. Everybody is there to sell. So is there any liquidity left now? No. So are they able to roll over their debt? No. So they get bankrupt. Okay, how will they cover losses? They will cover losses only to an extent of their equity. Equity gets wiped out. End of the story. Okay, so by summer 2007, short-term wholesale funding market started to freeze, including both the ABCP and the repo market. Government took positions. Government did certain things. And at this point of time, there were only 3 outcomes for the companies: bailout, merger, bankruptcy. Okay, some were bailed out, some went bankrupt, some were merged. Okay, now another issue, like the core issue, was valuation uncertainty. Nobody know what the actual value is for the asset-backed structured products like asset-backed securities. Okay, first, complex liability structures were there, and complex cash flow waterfalls were there, that how the loss will be distributed. Okay, everything was complicated. Then different types of collateral and interest rate triggers. Different types of collateral were there, and different interest rate triggers were there. Customized models needed to fit the unique aspects of the product. Customized models were built. There are no generalized standardized models were there. And if it does not fitting the data, then model, then I should think about something changing in the product. But what they were doing, they were creating the product and then changing the model accordingly. Okay, so that the model will produce that, okay, yeah, the loss will be always very less, AAA rating. Okay, the pool contained thousands of subprime mortgages, which required evaluations. Okay, complex instruments such as CDOs, CDO squared, synthetic CDS had to be valued. These were very difficult to value. Okay, so many investors, even sophisticated investors, they did not have that expertise in-house to understand the complex products that you are buying. So a bank dealer is calling me, okay, you buy this, it's really good. And I'm saying that, okay, too many are defaulting nowadays. How would I know that I'll not this product, there will be lesser number of defaults? And the dealer is saying, no, there will be no default. So do I have that knowledge to cross check it? No. So I will not buy it. I simply stopped buying. Then that's led to the another reason for freeze in the liquidity. So wipe out of liquidity. Okay. Now, the valuation of illiquid assets was also opaque, which made investors skeptical and of reported prices. So whatever the price was being reported, they were not believing. Oh, no, it is not the correct. It is not the correct assessment of counterparty credit. There is some problem and I'm not going to buy it right. Okay. And the lack of transparency actually extended to all the types of product within the SIVs, all the types, no matter whether the backing was for credit card loans or for any other safer loans, everything suffered. Okay. 2007, Bear Stearns tries to rescue 2 hedge funds that were threatened by the losses of subprime mortgages. Bear Stearns tries but fails. Prime broker for one of the funds, Merrill Lynch, sized 850 million in collateral, but could not sell them easily because of illiquidity. So there was collateral worth $850 million, but it was not easy to sell. Liquidity was not there. Okay. 2007, BNP Paribas froze 3 funds with $2.2 billion in asset because it could not value their subprime assets. they were not able to value how much of this $2.2 billion is subprime. So they froze it. The significant exposure of large financial institutions to subprime mortgage created a lot of worry. As I said at the start, do you remember when I was discussing OTT model? It was supposed to distribute, but what happened? Instead of distributing these big banks, they started to take it on their own books for extra income. Okay, so again, they came into the radar. Okay. Now, what was the response? Central banks, how did they respond? So things were going haywire. Now, central banks had to intervene. First, they started long-term lending facilities. Okay. Then they financed the purchase of unsecured CP and ABCP so that some liquidity can be brought in. That, okay, government is doing something, we need to have trust. Things will back to normal. Then they opened a discount window where they were ready to buy illiquid assets at a discounted price. Okay. Then they tried to increase liquidity, okay, in the money market funds. Okay, so they infused capital, they did a lot of things there, lending funds against high quality illiquid MBS. Okay, if a bank had high quality illiquid assets, then they were lending money against that okay, you take money, I'll keep it as collateral. Okay, it's illiquid, not a problem, it's my problem to sell it, you take money, because liquidity was the biggest concern. Then purchase of the assets of Fannie Mae and Freddie Mac. They started to purchase the assets of Fannie Mae and Freddie Mac. These are the institutions that were actually issuing securities, right? They were that were actually handling these securitization things. Okay. So next, what was the response of US government in this regard? First, they came up with TAF program, term auction facility. Okay. Then they started prime dealer credit facility. So if you're a prime dealer, we will provide you credit facility so that it will help infuse liquidity into the market. Economic Stimulus Act was brought in where a lot of bailout was given. Okay. Takeover of Fannie Mae and Freddie Mac. These two institutions were completely taken over, okay, by the government. Then TARP program, Troubled Asset Relief Program, where troubled assets were actually taken by the government and money was given in exchange. Okay. So these were the things that were done by the government. And with this, we can say that we have completed the discussion for the today. I hope you guys were able to understand the concept properly. So, and at the same time, this is the last session of the crash course. So finally, we are closing it. And I wish you guys all the very best for your examination. I hope you guys were able to understand everything, and I hope you guys will do really good in the exam. Okay.
Thank you so much for the session. Last class video is not uploaded.